I don't see why the Fed would be rushing to be cutting rates in an environment where inflation is still sticky. That was true 3 months ago. It's true today.
They want to be a little bit cautious about how sanguine they are on the number of cuts that they will be able to deliver this year.
Whether it's 1 cut, 2 cuts, 3 cuts, we don't care because it's the start of a bigger cycle.
If we do, in fact, hit some kind of economic speed bump or a recession, there's actually scope for rate cuts.
The Fed's got to try to buy time here. They're between a rock and a hard place.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It's Bramo's favourite phrase. Let's get you to the weekend.
Yes.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. AMH has already started hers. She's going to be back on Monday. Equity futures right now on the S&P positive by 0.7%. Let's get the two names up on the screen. Alphabet and Microsoft. They do not need rate cuts from the Federal Reserve. Alphabet's up by 12% in the pre-market. We're talking about beats on the top and bottom line. And Bramo, throw in a dividend, throw in an extra $70 billion share buyback.
So what is this worth in the market? Last night I was calculating it and trying to put it into perspective because it's one thing to see just a random share gain 11%. It's another thing for it to be Google. That was about $400 billion of market capitalization combined yesterday after the bell that was added to these two names. That's almost equal to Walmart. That's basically two McDonald's. I was looking at this last night and I was thinking,
that's ridiculous.
It's unbelievable to see two names dominate in this type of way. Dan
Ives of Wedbush is in and around the studio in a bright pink jacket, very happy with himself. He's going to join us in about 10 minutes' time. Dan Ives of Wedbush says this is the mid-90s, not the late 90s. The mid-90s, not the late 90s for tech stocks.
What you can see is actual monetization. And that's what people got excited about, is that essentially this isn't just nice words about how artificial intelligence is going to make robots cook our dinners for us. This is about them actually expanding their cloud services and increasing the number of customers because of artificial intelligence. For Google in particular, it was really a watershed moment because they were showing that they could monetize and grow with their cloud services in a way that a lot of people weren't expecting.
And they've had some big challenges in the first quarter. We were talking about maybe them putting ideology before facts, and maybe there was a big threat to the search engine. We'll be talking about that a little bit later. Need to move to the bond market. New highs for the year on a 2-year yield, on a 10-year yield in the last 24 hours. The 2-year right now, close to 4.99. The 10-year briefly through 4.70, back down to about 4.6837. The word stagflation just echoing around trading floors worldwide in the last 24 hours. And I wonder how misplaced that is. BMO's Ian Lingan calling it stagflation chatter. Is it anything more than that after the data from yesterday?
If you look under the hood, it didn't look that weak. A lot of people talking about stagflation. Some might argue, that was premature. I think Bruce Kasman of JP Morgan actually nailed it, and he's coming up on the show, where he said basically that sound that you hear is the breaking up of a narrative, is the destruction of a narrative. And essentially what we are is destroying this sort of immaculate disinflation, this question of we don't know where we are. And my question to the bond market today is just how much have we actually priced out any rate cuts this year until December? Have we fully done that through the entire market, or is this just select pockets that are starting to wake up tonight?
Yesterday, we were eating away at December as well. 8:30 Eastern time, we'll get the PCE data. That sound you hear, I actually think it's the yen breaking. Dollar yen right now, 156.67. Let's go through the month again. Coming into the month, 152, well, no. 153, 4, 5, 6. Staring down the barrel of 157 at 156.82. At about 4 a.m. Eastern time, there was a big swing, Bramo. Everyone started to chatter about intervention. We're back to where we were, 156.66.
The narrative has also changed around this. George Surveillance of Deutsche Bank, I think, nailed it. Benign neglect. That is the phrase you will hear, that essentially this is a Bank of Japan that doesn't care. It's like, okay, I guess that this is happening. We've got a weaker yen, but does it really bother the Japanese economy? And he went through all the reasons why it doesn't really matter, which is the reason why fight it, especially if it's going to be a losing battle in the face of hotter than expected U.S. data.
Kit Jukes of SocGen, the yen's decline is becoming disorderly, which points to a final potentially sharp decline before it finds a floor. Let's see if this is going to be the potentially sharp decline before it finds a floor. To your point on the economic data, I put out the survey on Twitter a little bit earlier this morning. Who needs a soft inflation print more? Chairman Powell, President Biden, or the Bank of Japan right now? Because I can tell you at the moment, the BOJ must be begging for a downside surprise on U.S. data.
Right now, that seems like the only off-ramp they have, because it seems like they have adopted a posture of caring more about personal consumption and more about inflation, which still is in around 2% in the region, which raises the question, do they really care about the yen weakening or not? Essentially, they're trying to have this attitude of, well, we don't care anyway. It's sort of this like, in high school when someone is sort of annoyed at you for something that is very endemic to who you are, you just sort of are like proud of it and wear it on your sleeve.
Get dumped at high school, is that where you're going with this?
If you want to go there.
I don't care.
It's like, oh, whatever, I didn't like them anyway. Yeah, exactly.
Keep selling my Japanese.
Exactly.
Dollar yen right now, 156.65. No idea where this show's going. Equity futures more broadly on the S&P 500. Let's get to the market story for you. Equity futures positive by 0.7%. Yields a little bit lower. We're down 2 basis points, 468.37 on a US 10-year. Coming up this hour, we'll catch up with Christian Nolting of Deutsche Bank with stocks rebounding, Dan Ives of Wedbush on Microsoft on Alphabet's blockbuster results, and Sarah Wolf of Morgan Stanley ahead of PCE data and next week's big Fed decision. We begin with our top story. Stocks gaining on better than expected results from Microsoft and Alphabet. Investors shifting focus to data with the Fed's preferred inflation read due out at 8:30 Eastern Time. Deutsche Bank's Christian Nolting joins us now for more. Christian, we'll talk about the data in just a moment. I want to start with the tech earnings. Alphabet is absolutely flying in the pre-market. Yesterday it was a kind of different conversation. We were focused on Meta gapping lower. Do you think that the tech trade in America, Christian, is alive and well?
It seems like, but I have to say, right, without the good earnings we got over last night here from Europe, I think the market would have reacted a bit differently. So it was a bit jittery from my point of view. But I think now if you see especially the outlook coming in positively, I think that's really good news. And you see that in the futures being up at this point in time.
The digital ads looked pretty solid. Cloud spend looked pretty solid. We'll catch up with Dan Ives of Wedbush more specifically on these single names. But Christian, for you, when you're looking to overweight equities, take that exposure, is there anything outside of US tech and US equities more broadly?
Honestly, if I'm here talking from Europe, right, if you look at the European performance for the time being, if you look year to date, even from a dollar perspective, it's outperforming the S&P if you look at the Eurostoxx 50. And the question is, why is that? I think there's a lot of investments in tech. There's a lot of investments in the US. But interestingly, talking to clients just recently, they think also maybe there's some value in Europe. I'm not saying that's forever the case, but for the time being, we do see some investments here. It's more on the value side because there's simply not so much tech in Europe. But I think that's also performing quite interestingly. So that's, I think, good news from a European perspective.
I love this, Christian. This is where we are right now in the cycle. People think there is some value still in Europe. Really, it's not all isolated to the United States. There is a question, though, just more broadly of how much people have really internalized this idea of no rate cuts this year for the Federal Reserve. Has that truly been baked into the idea of what that means for broadening out in the rally and potentially everything other than the Magnificent Three?
Yeah, it's no longer 7, right? So, no, I think importantly, if you look at the rate cut story, I think what needs to be discussed is the rate cut story is not about the economy being, let's say, so weak that there needs to be rate cuts. It's still about the strengths in the economy. And, of course, the inflation, which we call high for longer, not higher for longer because we think it's not going through the roof. It will stay at an elevated level. I think that's important. So I would still think, and that's why I don't think it's priced out, that there is a cut of the Fed this year, probably in the fourth quarter. And I do think, and I think it's really priced in the market as well, that the ECB will cut in June. And then let's see, probably every quarter they will cut. By the way, that's also making probably Europe more attractive and quite interesting. So I think this rate cut story is not over from my point of view.
A lot of people are suggesting now that the pivot party is over. Well, the other thing that can sustain us is this idea of stability. If we don't have volatility in rates, that's enough to sustain some sort of rally. Do you buy that, or do you think that if we have stability at these levels, that's going to really change a lot of theses that are just hinged on this idea that the rate cut will come?
I think what we really watch very closely is the real rates. For example, if you look at the 10 years, now 2.25 in the US. I think whenever this is moving faster, then the equity market also gets, say, a bit nervous and volatility is rising. So as long as it's quite stable, that seems fine. But if that's rising faster, which we have seen just recently, then you see also a slight pickup in volatility. But again, if that's stabilizing from that point of view, I think that's quite a decent outlook. Nevertheless, also in terms of where we are in seasonality, I think if you take some gains of your overweight position, it's probably not wrong. And if there's a kind of setback in the market, which I would say is sound and maybe welcomed, then it's rather a buying opportunity. So that's how we position. It's no longer completely overweight on the equity side.
Christian, let's focus on the data that came out yesterday. We've got PCE at 8:30 Eastern Time. What did you make of the growth inflation mix of yesterday's data? Lisa and I were talking about it briefly. We just heard that word stagflation echo around trading floors worldwide following that data yesterday. Christian, what did you make of the growth inflation mix here in America?
Yeah, it's probably the worst outcome for the central bank if you think through, right? So growth coming down and inflation moving up. Yeah, of course, you have then the discussion about stagflation, but honestly, I'm not in that camp. We do see growth coming down, but not to levels which are very, very low from that perspective. And as I said, I don't think inflation is moving much higher from here. It will stay elevated, but from that perspective, I'm not in the camp that there's pure stagflation all over the place. I think there is, down in the second half of the year, some room for rate cuts, and from that perspective, I would not be so negative.
Where does that leave your view on treasuries, just briefly? At 470 yesterday on 10s and 2s, crossing 5% all over again.
So if I fast forward, say, into the second half, even into 2025, we think we can, so 470, we can imagine we are 430, 420 in 1 year's time, which I think is a benign environment for the fixed income space, which is following then the view inflation is not moving substantially higher from here. So I think it's not too bad on the fixed income side where we are right now.
Christian, good to hear from you, sir. Christian noting there of Deutsche Bank following some stellar earnings from Alphabet and Microsoft. Alphabet in the pre-market, absolutely flying. What was it, $200 billion in market cap this morning?
Yeah, 200. Yeah, I think that was something like that. Yesterday, it was $250 billion.
Nuts. Absolutely crazy. On the bond market, we'll catch up with Gershon Distenfeld of AB a little bit later this morning. He thinks this is an opportunity, the second one, to get a second bite out of this bond market and lock in what is available to you right now, which is 470 on a 10-year.
Which is exactly what I thought was so interesting about Christian noting. Gershon Distenfeld has a similar kind of idea. We haven't really killed off expectations for rate cuts. People still are holding out hope. If we get a hotter than expected core PCE print today, if that does kill off some of those hopes, how much more of a move do we have left? Versus, how much of a rally could we see if suddenly we get a weaker than expected print and people start to rally once again around the pivot?
We explored that yesterday. I don't think it would take much to just reintroduce the conversation of a rate cut this summer. You get one soft print on inflation, off to the races, the conversation starts. Look at yesterday. Yesterday, all it took was just a downside surprise on growth and an upside surprise on PCE, and all of a sudden we're hearing about stagflation in America. So at once, all of a sudden you're seeing note after note with the S word in it.
That's because people have no clue. I mean, this is basically the sound of people just throwing darts at a dartboard, because essentially we don't know where we are, which is the reason why we're seeing such volatility. I'm curious to ask Dan Ives about what volatility of 10 or 11 or 12 or 14% on some of these mega cap $2-3 trillion names really means. I mean, they're trading like penny stocks, which gives you a sense of how little certainty there is right now.
Dan Ives, 5 minutes away. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Secretary of State Antony Blinken has met with Chinese President Xi Jinping in Beijing. Xi warned Blinken against, quote, vicious competition between the countries, saying China and the United States should be partners rather than rivals, according to a Chinese Foreign Ministry statement. Blinken, for his part, warned China on supporting Russia's war machine. The Bank of Japan kept rates on hold. It sent the yen to a new 34-year low against the dollar. Japan's finance minister said that the government will respond appropriately to foreign exchange moves. They didn't respond at 150, 155, and now we're past 156 in a very volatile day of trading. George Saravelis of Deutsche Bank writing this morning that the losses are warranted and that this finally marks the day when the market realizes that Japan is following a policy of benign neglect for the yen. Blackstone's credit chief has downplayed the industry's rival with banks, even as banks step up to muscle their way back of the market share of lending. Gilles Delart spoke with me exclusively in his first interview since taking the job.
This year, spreads have tightened because public markets in large part are back. And I think that gives borrowers a great choice to be able to say, look, I want a public financing deal or I want a private option where there's maybe more execution certainty and it comes with other features. And that choice is a good thing for the financial system.
When I asked him whether that meant that private credit share of lending would fall, he said that instead of dropping, it would ebb and flow throughout cycles. That's your Bloomberg Brief, John.
Danny, great exchange there. Appreciate it. Thank you. We'll pick up on some of those themes with Mohit Mittal of PIMCO in about 20 minutes' time. Equities right now negative, or rather positive, by 0.7% on the S&P 500. Up next on the program, the AI boom in full swing.
The one theme that we've been seeing between Meta, Microsoft, and Google is everyone is spending a lot more on CapEx. This is clearly going to all AI data center infrastructure today.
That conversation up next, live from New York this morning. Good morning.
Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Tech stocks absolutely flying in the pre-market. Equity futures on the S&P 500 positive 0.7%. Yields a little bit lower, down 2 basis points, 468.16. Under surveillance this morning, the AI boom in full swing.
The one theme that we've been seeing between Meta, Microsoft, and Google is everyone is spending a lot more on CapEx. This is clearly going to all AI data center infrastructure today. What's so different about the dot-com era is we're not seeing money wasted. We're seeing these companies actually making money early on these services because they're charging so much for them.
Here's the latest this morning. Shares of Microsoft and Alphabet rising in the pre-market after both companies reported earnings that blew past estimates. The tech giants saying spending on AI and cloud computing is paying off. Dan Ives of Wedbush writing this. Microsoft continues to put together masterpiece after masterpiece as this quarter represents its dominant position in the AI revolution. Dan has an outperform rating and $500 price target on Microsoft. Dan Ives joins us now with a big smile on his face. Dan, good morning to you.
Great to be here.
Dan, tell us why this is the mid-90s and not the late 90s.
Yeah, it's a 1995 moment, not a 1999, because the spending, it's unprecedented. And that's why there's two companies that you're listening to understand where to gauge adoption. The godfather of AI, Jensen, NVIDIA, and then what's happened, Redmond with Nadella. Well, we heard last night, the adoption is even massively ahead of their expectations. And when you start to put numbers through, we believe this is going to be an incremental $1 trillion of spend over the next decade. To bet against that, you know, I view it's like betting against the Knicks in this playoff.
So help us understand this, and we'll get into the basketball later. Meta spending bad, spending at Microsoft and Alphabet good. What's the difference?
Where's Meta spending? Now, they're spending like a 1980s rock star, but they're spending on AI. Microsoft's getting that, Google, Amazon. So, and our view on Meta is that that's actually good money after good. You want to see them spend on AI, not metaverse, but it just speaks to where all this money is going. It is going to a fourth industrial revolution, and you could debate economics and everything that's happening on macro, but the monetization's here. And that's why as a tech bull, you were sleeping very well going into this weekend.
Evidently. I am curious, though, about whether all big tech is created equal. You talked about all spending not being created equal. Is the benefit of Google and Microsoft to the detriment of, say, Amazon that struggled to keep up with their AWS offering?
We'll find that out. But actually, I think Jassy has actually started to get them on the right track from an AI perspective. Now, if you look at Google, Amazon, they clearly were behind Nadella and Microsoft, which were top of that mountain. But I believe we're going to hear good things from a cloud perspective, potentially re-accelerating. And you look at Anthropic and some of the AI initiatives they're doing, I think they're going to be more acquisitive. And look, this is an arms race going on right now in terms of AI. You're going to see more acquisitions across the board. But it speaks to, from a tech perspective, this is a tech bull market that's still in the early stages.
So more acquisitions, size is your friend. We've seen that time and again, and that seems to be the consolidation that we're seeing in the likes of Google and Microsoft. What consolidation do you think will be allowed and is feasible with some of these tech giants?
Well, look, I think if you look at Microsoft, they could really, they're free as a bird because everything that they did in the 1990s from a antitrust DOJ, now they're going to be more and more aggressive from M&A. And I think when you look at the rest of tech, they're no longer scared from an FTC, in terms of what's happening there. You're starting to see more and more bigger deals. IBM's getting a lot more acquisitive. You're not going to see big tech just sit there in their sort of rooms, not going for big acquisitions, because otherwise others will do it, private equity and other big tech giants. And that's why you're seeing much more of an offensive approach from Alphabet, from Amazon and others. And I think this is a trend that we're going to see throughout tech earnings season.
There's a lot to unpack here, and we'll get into the politics of this in a minute. I'm sure Lina Khan is listening and wondering exactly how this is going to happen. I am wondering, though, what they're going to go after. What types of companies? Are we going to see, for example, Microsoft, I don't know, buy something that rhymes with Wickwalk? Or are we going to see something like, a situation where we're talking about a Netflix acquisition?
Yeah, I think it's really going to be more on the software side, because now the baton in the AI revolution has been handed from semis to software. The use cases, that's where it's all starting to morph. And we've seen it. You look at ServiceNow, you look at Salesforce. It's just starting this phase. I'll call it the second derivative of the AI revolution. You're going to see big tech focused on software, potentially on cybersecurity. Talk about Microsoft, TikTok. Look, our view is TikTok, despite legal challenges, it's Microsoft or Oracle that will be number one and number two potential acquirers of that without the algorithm.
Where does that leave Apple next week into earnings?
Look, right now, the New York City cab drivers bearish on Apple into earnings. I believe as the AI story comes to Cupertino.
Cab driver's got good reason to be, though, right?
Cab driver has good reason. But if you betting against Cupertino and Cook's been the wrong move. And now when you look...
Right move year to date.
Right move year to date. I think we sit here 6-9 months from now, and I believe they see a renaissance of growth, not just because ultimately what we're going to see in China as units have easier comms second half of the year, but it's the AI story that will be unveiled, WWDC, AI technology incorporated into iPhone 16. And I think Apple's been on the outside looking in from a Mag 7 perspective.
Okay.
That will not be the case 6-9 months.
Do you think we should drop the numbers and stop counting iPhone 16 and just have, a new launch, a new product, which is the AI product? Are we that close? Are we actually going to see a big enough change to the hardware that they can say this is a brand new thing?
Yeah, and Gurman's talked about it a little too. I don't think we're there yet. I do believe this is a stepping stone to where they are going to go. But when you look at Apple from a services perspective, AI is going to be a massive tailwind. And I view Apple, I view Google similar to how we viewed Facebook, Meta 18 months ago. The point is they are on the cusp of a renaissance growth, even though China is the elephant in the room, obviously with Tesla and Apple, that continues to be why right now in this Mag 7 party, they're in the cold on the outside, behind the line, waiting to get back in.
And we'll get to that in just a second. Tony Blinken, some headlines coming from his meeting over in Beijing about talks on AI with China. Are you bearish on anything? I mean, Tesla, was that sufficient for you? Are you feeling like there's any name within the tech complex that maybe just isn't getting it done in the same kind of way?
Yeah, I mean, look, Tesla, we talked about. You need an adult in the room, and that adult was Musk. I mean, he did step up on the conference call, laid out the strategy in terms of a lower cost vehicle, and I think that was so important. But our view, when you say are we bearish or anything, of course, there's going to be losers of this AI revolution. But even when you look at the companies that I view maybe on the outside looking, like an IBM, look how aggressive they are in acquisitions. You're starting to see their mojo come back. And my view, to bet against tech in a fourth industrial revolution, it's betting against Mahomes in a Super Bowl.
Okay, you went to sport twice. Let's talk about basketball. You think the Knicks get it done? Are they better than the Celtics?
Look, Celtics obviously going to be a tough series, but I do believe Knicks could beat Celtics head-to-head. That's my view. I think we have a hot team right now.
Okay.
So my view is...
You're more confident on the Knicks or Apple next week?
I'm probably more confident on Apple, but I have a very high level of confidence. Knicks, again, once they get past Philadelphia, we'll call it Knicks and
Brunson or
Boston.
Cook? Brunson or Cook, and you're like Cook?
I'll take Cook and then Brunson in that order.
All right, cool. Dan, thank you. Appreciate it. Love how seriously you take this.
I was going to say, he
Dan
has got the same tone.
Some of the big tech names. We want to get to these headlines coming out of China. So Blinken confirming a meeting with Xi overnight, the Chinese leader. This is the readout, some of the headlines we're getting from this. The last trip here was at a time of profound tension. I made clear our policies and intentions. I came to China to take stock of progress. The two governments agreed to close loopholes on money laundering. Went on to say China needs to prosecute those in the business of making fentanyl. More headlines here to go through. We'll get to them in just a moment. Coming up very shortly, looking ahead to core PCE with Mohit Mittal of PIMCO. That data 2 hours away, live from New York. This is Bloomberg. Stocks doing nicely here, up 0.75% on the S&P 500. On the Nasdaq 100, the bounce continues, driven by Alphabet and Microsoft. We're higher by 1 full percentage point. Let's switch up the board and get into the bond market. New highs for the year on a 2-year yield, on a 10-year as well in yesterday's session, briefly through 470. This morning we dropped back below that, down about 2 basis points to 468.57. On a 2-year, 499.54. Just in at around 5%, Bramo, over the last few weeks.
Basically, there is a concession suddenly, at least in certain markets, that we're probably not going to get more than 1 rate cut this year. How much that's percolated out into the rest of the market, that is a question that I'm curious about, because there still is that hope lingering for so many people. Yeah, this is just a head fake. It's going to come, believe me.
Speaking of the hope for intervention over at the BOJ and the Ministry of Finance in Japan, the hope continues. It's level after level. Let's get to the levels right now. We're talking about session highs pushing 157. 157. We're at 156.74. Lisa, we took out 152. 3, 4, 5, 6. We're looking at 157. And there's still no sign the BOJ is going to get involved in any of this, or the Ministry of Finance either, because they're not saying a thing.
I keep going back to George Saravelos of Deutsche Bank, and Danny Berger pointed this out as well, this idea of benign neglect. And that seems to be the feeling. It doesn't really matter whether the yen weakens all that much to the Bank of Japan. And so how do you really understand what move would be enough to matter at a time when potentially they're still looking for inflation to increase? Tourism is going gangbusters. Everyone wants to go see the cherry blossoms. Everyone who comes here, where they say they've gone to Japan, they just get the smile on their face. They say it's just, there's a new energy there.
Sure, 157's the energy. If you're funded in US dollars and you're going on vacation, that's where the energy's coming from.
Have we not heard that from literally every person
everyone's
who's come
just
on
got
this
back from Japan. It's a new dawn. It's a wonderful thing.
Where do you want to go?
Yeah, everything's like half price.
I know.
Congratulations.
Exactly.
I know. I think you nailed it earlier this week. You absolutely nailed it. Do they risk more credibility if they step in and it doesn't work? Isn't that the risk facing the Ministry of Finance, looking at 157 on dollar yen?
That's essentially why this does feel a little bit like the high school analogy that we were talking before. Because essentially, if they were to step in and it wouldn't work, they'd be throwing good money after bad, and that would be a huge problem from a whole host of perspectives. So now if their tone is, we're watching it, it doesn't concern us, not a big deal, then it sort of downplays the expectation for them, and frankly, it gives them more credibility. Key question that I have is, how many rate hikes does that imply for the Bank of Japan? Maybe not now. They don't want to be bullied into this. They want to do it on their own time, but later in the year.
156.76. We're all watching that currency pair. Under surveillance this morning, our top story, shares of Microsoft and Alphabet rising in the pre-market. The tech giants reporting earnings that easily beat Wall Street estimates. Both companies saying spending on AI and cloud computing is paying off. Just a very different story yesterday afternoon, Lisa, compared to what we heard 24 hours before from Meta and how the stock responded to what Meta had to say.
You put it well. You said, why is this spending different from all other spending on this Passover season? And there's this real question here about what you're spending on. And for these companies, they're spending on things that are actually delivering revenues. To me, when people say every sell-off is a buyable dip, which sell-off in what, right? I mean, is this sort of the dip that people are buying? The moves that we have seen in big tech are just astronomical, and they are diverging. So it raises the question, what do investors do with this? Do they pile on because, oh, yeah, you got a 70-cent dividend? I mean, there's so much to really discuss here in terms of understanding the market's lack of understanding of where these names should be valued.
The capital return program over at Google gets a whole lot bigger overnight. The latest out of China, Secretary of State Antony Blinken and Chinese President Xi Jinping meeting in Beijing. The sit-down coming as China says problems are mounting in the relationship with the United States. Speaking after the meeting, Blinken saying the two governments have agreed to close loopholes on laundering and agreed to hold talks on AI. I'm far more interested in the foreign policy here. Reiterated a concern on China and components coming out of China going to Russia. Also bringing up Iran, urging China to use their influence over Iran to limit the conflict in the Middle East. This is about the influence that China has over rogue actors on the international stage at the moment and how much influence America has over China to do something about it.
And what the incentive is for China at a time where they're seeing increasing competition and, frankly, they're seeing that economic pressure. I mean, the language coming out. Did you understand what this meant, that actually there was progress, or at least ties had stabilized since Xi and Biden had started talking, but negative factors were increasing? Do you understand what that means?
No.
Okay, thanks.
So there are negative factors that are getting worse, but we're at least talking. Is that what they're trying to say?
I guess so. And
There's
maybe
some dialogue?
I do think behind closed doors, the discussion might look like we're better than the other guy, so work with us. I mean, essentially, that's...
You said that yesterday.
I actually do think that that's part of the discussion.
Well, based on some of the tariffs that he's thrown around, could be.
Yeah, but you know what? The tariffs under somebody else could be a whole lot worse. They're not going to deal with anything other than this. The question is, what is their willingness to engage at this point?
That's the latest coming out of China. Here's the latest this morning. The Fed's preferred inflation read due out in just under 2 hours' time. The median estimate in Bloomberg survey calling for the core PCE deflator to rise 2.7% from a year ago. It's the last data point before the Fed's rate decision next Wednesday. I'm pleased to say that waiting patiently around a table as we go through those stories is Pimco's Mohit Mittal. Mohit, great to see you, sir. Thanks for being with us. Thank you so much. Let's talk about the data in about 2 hours' time. What would it take to just reintroduce a conversation about rate cuts this summer at the Fed?
Yeah, so I think if we just take a step back, by the end of last year, the core PCE inflation on a quarter-on-quarter annualized basis had dropped towards 2%. Based upon the recent data, it's now tracking closer to 3.5% on the core PCE basis. Today's data point will be quite important because it will feed into Fed's summary of economic projections that will come out in June. So what the Fed would like to see is, by the end of this year, if we are on near 2 point something on inflation, that would be sufficient to get a cut or two by the end of the year. If we are in the 3% range, that would make any cuts quite difficult for this year.
We've been on quite a journey in 2024 already. It's only April and we've gone from 7 cuts to something like 1 or maybe less. Yeah. What do you think the trade is now after we've discounted all of that through the first 4 months of this year?
Yeah, I think the value is returning into fixed income quite nicely now. At the beginning of the year, we had, as you mentioned, almost 7 cuts priced in. That, to us, looked a little bit more excessive. Now, with most of those cuts taken out, almost less than 2 cuts priced in, the value is back into fixed income. So I think the trade here is to start thinking about fixed income on a little more longer-term basis where you can get over 6% yield. In most states of the world, you realize that 6% plus yield. And then in a scenario where growth starts to slow down or inflation comes down, you could easily have a double-digit return, as the Fed will then have to cut more than what is currently priced in.
Value is back, 6 months ago when value is a lot, cheaper. So there's a question here of what you're buying. Is this the idea of duration and just holding long-term treasuries? Is this credit, even though you have seen that rally in spreads? Or is this something else within the sphere, whether it's in the private world or elsewhere, that you see as holding the most value?
Yeah, I think to us, the value is in broad, high-quality fixed income. So that includes some duration, but that also includes agency mortgages and other high-quality fixed income assets like even some investment grade. So that to us, as well as some structured products. So the idea here is that you can construct a high-quality fixed income portfolio that yields north of 6.5%, even 7%. And that's what I mean by value is back in fixed income.
So what are your conversations like with insurance companies and with pensions, who for years were talking about the 8% bogey? And I remember everyone just saying, okay, they're not actually going to make that. What are they actually buying? Are they just levering up shares of Microsoft and hoping for the best? How excited are they? How much money are they pouring into the strategies that you manage?
Yeah, so I think the insurance complex as well as the pension complex is quite excited with the backup in yields that they have seen. So they are finally able to lock in north of 6% yield for an extended period of time. And you're seeing that through flows from pension community as well as from insurance community into fixed income have certainly picked up this year. So certainly for them, it's an opportunity to lock in these high yields for an extended period of time.
This has been a theme on this program so far this week, just how much investors were conditioned by the pre-pandemic universe of fixed income, which is there is no yield, stay away and buy equities. There was a conversation, I remember, we talked about it, Lisa, a million times, that you go to equities for income. And at one point, you go to bonds for capital appreciation as everything was seemingly going negative in Europe and elsewhere. Do you think investors have shaken that psychology of pre-pandemic? Do they realise what's on offer? Do you see money migrating from elsewhere, from other asset classes, into fixed income?
I think at the margin, yes, certainly that is happening. I think investors are also thinking about cash as an alternative. So for now, many investors are keeping money in cash because they can recognize that 5.25%, 5.5% yield on cash. But the challenge is that is only giving you that yield until the Fed begins the rate cut. So I think once that rate cut process begins, you will see more money flow into fixed income. But certainly there is value in fixed income.
This introduces the US exceptionalism argument. There are some people making this argument that this is going to last a long time. You don't have to worry about that reinvestment risk because it's still going to be there on offer for you 6 months out, 12 months out. You've used a word that I've not heard for a while, convergence and not divergence. Convergence between the US and the rest of the world at a time when everyone else is talking about divergence. Where does that convergence come from?
No, from our perspective, we certainly see more divergence from a growth and inflation trajectory in the U.S. versus rest of the world. So, U.S. growth easily around 2.5% in real terms, inflation around 2.5% to 3% in real terms. Compare that to Europe and UK at around 0.5% in real terms and inflation around 2%. So there's certainly a divergence on that front. What I was referring to is that from a rate perspective, now that rates have moved back relative to where they were at the beginning of the year, you certainly see more value in being able to find opportunities in the US as well.
I have to go here. I'm sorry. The deficit.
Yeah.
Does that worry you?
Yeah, it certainly is a big worry for us. I think, as far as we can see for the next 5+ years, we are penciling in closer to 6.5% deficits. And it doesn't change depending upon the election outcome. It will likely stay the same high deficits for an extended period of time. And I think the way it plays out in the bond market is through steeper yield curves. So that's why, when we are thinking about value, we are thinking value more in the intermediate point of the curve, whereas the longer end of the curve will remain impacted by the higher deficits for longer.
There's a fear that if there is some sort of weakening in the U.S. economy, that there won't be the same kind of rally in treasuries because any kind of fiscal spending will add to a deficit that really exploded during otherwise good times. Do you adhere to anything like this, or do you think that this is just not the way it works in government bond markets, even though that might work for any of us who might be spending in a profligate manner during good times?
I think in a genuine risk-off scenario, U.S. Treasuries will be the safe haven asset. Dollar will remain the safe haven asset. So while certainly deficit can go up in that scenario, there will certainly be more demand, particularly given the starting level of yields in U.S. fixed income in a risk-off scenario for U.S. Treasuries.
Elisa is going to be so much happy that someone just said yes to that first question. Are you worried about the deficit? Yes.
Hold on a second. Actually, I've been thinking a lot about whether it makes sense to even worry about it.
Okay.
There are arguments on both sides. And actually, there's an argument that if things get bad, the Fed's going to cut rates so much, the deficit goes down. So, there are all sorts of arguments that are really interesting to me that it just goes to the heart of this idea of the lack of conviction right now in understanding what paradigm we're in and whether what matters and what doesn't. I mean, it's fascinating.
Balanced Bramo on a Friday. Mahit Matav, PIMCO. Mahit, thank you. It's good to see you. Appreciate it. Okay. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. According to the Journal, Donald Trump's allies have drawn up plans that would give Trump a say in monetary policy should he become president. The plan would be to have the president consulted on rate decisions and give him the authority to remove Jay Powell before his term ends. Trump has long professed his preference for lower rates, so the concern among some is that the political interference would force the Fed to tolerate higher inflation, possibly raising long-term rates as the government rolls over trillions of dollars of debt annually. JP Morgan is continuing to revamp its leadership in Asia. The bank has appointed 48 executives across Asia into managing director positions. It's already made a string of changes in leadership in its Hong Kong and Shanghai offices. As you'll recall, JP Morgan reported earlier this month that net interest income missed estimates amid a very high bar, and that sent shares tumbling 6.5% on the day. Let's get a quick check on Intel shares for you there. Lower pre-market, down 7.33%. They reported earnings. Second quarter outlook came in weaker than expected, highlighting some of the difficulties that the chip maker has had in executing a turnaround. Shares are already down 30% this year. It's one of the weakest performers in the Philadelphia Stock Exchange Semiconductor Index. Stifel analysts say that this is likely the bottom, but the climb back up, the pace of which, that's unclear. That's your Bloomberg brief, John.
Hey, Danny, thank you. Much more from Danny in about 30 minutes' time. Up next on the program, the Fed's preferred inflation gauge on deck.
I don't see why the Fed would be, rushing to be cutting rates into an environment where inflation is still sticky. That was true 3 months ago. It's true today.
That conversation up next. That data about 2 hours away. Bouncing back this morning, Alphabet up big time in the pre-market following earnings yesterday afternoon. Equity futures up by 0.7%, yields lower by a single basis point, 468.99. It's all about the data this morning. Under surveillance, the Fed's preferred inflation gauge on deck.
We believe inflation is going to prove more sticky than it has. Sticky for us would be that the Fed's preferred measure, which is core PCE, it may settle at 2.5 versus 2. And the Fed's not, I don't see why the Fed would be, rushing to be cutting rates into an environment where inflation is still sticky. That was true 3 months ago. It's true today.
It's the latest today. The core PCE deflated due at 8:30 Eastern Time. The median estimate in Bloomberg survey calling for a 2.7% increase from a year ago. It's the last data point ahead of Wednesday's Fed decision. Sarah Wolf of Morgan Stanley writing this: we expect little change to the FOMC statement, but see the risk of a more hawkish press conference. We expect signalling on tapering QT with an announcement of the parameters and start date to begin in June. Sarah joins us now for more. Sarah, let's skip the data this morning and go straight to Wednesday. What are you expecting from Chairman Powell in that news conference?
We're expecting Chair Powell is going to want to be patient. As we already heard from him a couple of weeks ago at the IMF, that the inflation data in the first quarter gave him a lack of confidence that inflation's moving in the right direction. The data we got yesterday only corroborates that we saw a little bit of progress on inflation, but not nearly as much as the Fed would like to see. And in particular, that monthly run rate is looking to be well above the 0.2% on the month that the Fed likes to see to feel confident. So while there doesn't need to be much change to the statement, when the Chair Powell is discussing in the Q&A the risk to the outlook, he's still going to emphasize upside risk to inflation and that they're going to be patient and need to see more incoming data to feel confident. There's no reason to rush into cuts right now when they clearly need more data.
Yesterday, Sarah, as you know, people were whispering the word stagflation. Let's talk about that data. Just how bad was that GDP print, really? Or how good was it? It was a big downside surprise, but when you look at the details, what was the story?
I think that there's good news. The economy is strong. If you look at private final domestic demand, which captures the domestic side of the economy, so consumer spending, business investment, residential investment, that was over 3% quarterly growth. So that's still a very robust economy. That 1.6% headline number came from trade and inventories, which are very volatile. Likely we see that reverse out in the next quarter. But the good news is that the Fed can be patient because the economy is still very robust. In particular, consumer spending still growing at a very strong pace, 2.5%. We're seeing that more of the dollars are going towards services over goods. So consumers are spending, but they're becoming more picky about how they spend. On the other hand, you mentioned some bad news. That was the higher inflation data. Based on the monthly data that we got for January and February and the inputs we have for March core PCE inflation, we were looking at core PCE for the quarter looking closer to 3.4%. The data came in yesterday, 3.7%. So what are we expecting today? Likely upward revisions to the prior 2 months and probably a stronger March core PCE print as well that we get in 2 hours' time.
Have you changed your view on how many rate cuts this year? Do you think that the market's got it right with one in December and that's it?
We haven't changed our view. In our view, the first cut still comes in July, but the bar is much higher to get to that cut now. We acknowledge that. You basically need to see a 0.2% core PCE inflation run rate the next 3 months in order to meet that bar for a July cut. As we know, the data has been extremely volatile. So putting confidence in just a 0.2% for the next 3 months is looking more shaky now that we're seeing much more volatile data. And paired with upward revisions, it's going to be important what type of revisions we see in the data this morning. The cadence of upward revisions, are they going to be coming in core services? Is more of it going to be in January and February? And March is still looking promising. And so that run rate going into April and May looks better set up for 0.2% on the month. But the bar is definitely higher. And as I mentioned, with the strong growth data, with jobs over 250,000 a month, the Fed has emphasized that the risk of going too soon seems much greater than the risk of being patient.
Which is the reason why some people who still believe in a rate cut cycle that begins mid-year are saying that maybe this Federal Reserve has some other things on its mind, like the Japanese yen. They care. They're concerned. They're central bankers to the world, and they want to prevent some type of volatility tied to a strong dollar. Do you believe that this Federal Reserve would be swayed by some of the international moves to just have some sort of adjustment, rate cut adjustment mid-year, even without an incredible improvement in the data?
We know that the Fed's dual mandate is maximum employment and inflation, and so they're going to be most focused on the incoming inflation data. Of course, they care about what's happening in the global economy to the extent that it impacts U.S. financial markets, and that could cause some nonlinearity or some disruption to the U.S. economy. So they're going to be taking global conditions into account. But the reality is that meeting to meeting, they're going to be much more focused on the incoming inflation data. And if they feel concerned that core services is much stickier than what they expected and they need more time to get inflation down, to 2%, they're going to want to be more patient. Inflation is going to be top of mind over what's happening globally, unless we see some type of significant disruption to financial markets. We know that the Fed has been able to backstop what's happened in financial markets over the past couple of years without having to adjust their policy rate. But who's to say how big this disruption could be and if it could push the Fed to move rates quicker?
This feels much more like a European question. We typically talk about the importance of the FX channel to the price stability mandate in places like Europe, in the United Kingdom. Does the Fed need a stronger dollar? Sarah, how much heavy lifting does that do for them?
The Fed doesn't need a stronger dollar necessarily. I would say that the biggest thing that's probably impacting inflation and actually helping us is what's happening in China, right? The slower growth deflation cycle. And so we're importing stronger core goods prices from China, and that's actually helping us reach our mandate. But the FX channel, while it has some impact on U.S. inflation, it definitely does not have as large of an impact as in Europe or as in emerging markets. And that's one of the silver linings of the U.S. economy, is that we're fairly resilient and insulated to what's happening overseas unless there's some type of large shock.
Sarah, just quickly before you go, base case for you and the team, is it still July?
Base case is still July, with risks if the incoming data over the next 3 months is more volatile or significantly above that 0.2% threshold.
OK. Sarah Wolf of Morgan Stanley. Sarah, great to catch up, as always. That data comes out at 8:30 Eastern time, the last big data point going into the Federal Reserve decision next week. Donald Trump, the former president, lots of things to say about the FX market and the importance of a weaker US dollar. This from the Wall Street Journal this morning. I'll read you the lead paragraph from this story. Donald Trump's allies are quietly drafting proposals that would attempt to erode the Federal Reserve's independence if the former president wins a second term, in the midst of a deepening divide among his advisors over how aggressively to challenge the central bank's authority. What did you make of that?
So Donald Trump, the next Fed chair, is that essentially what we're looking at? That essentially he'd be able to weigh in on this? I'm not sure what to make of this, because on one hand, you have to wonder whether this is just sort of campaign rhetoric. I'm going to take control of everything and everything is going to be great under my watch, versus actual proposals to dismantle some of the main institutions that govern markets, economies, and social systems in the United States. Hard to know the answer. It seems like a lot of people dismiss a lot of what comes out of his administration and in his campaign as just that, lip service.
Sure.
This isn't the first time, though, and this is the reason why a lot of people are saying September is going to be tough for the Federal Reserve to cut, because this is the type of rhetoric that's happening behind the scenes, in front of the scenes, and around the scenes at a time of deep political dissent.
You joke about the prospect of Donald Trump trying to set interest rates. OK, wait for this. According to people familiar with the matter, the former president, the Trump administration officials and other supporters of the presumptive GOP nominee have in recent months discussed a range of proposals, from incremental policy changes to a long-shot assertion that the president himself should play a role in setting interest rates. A small group of the president's allies, whose work is so secretive that even some prominent former Trump economic aides weren't aware of it, has produced a roughly 10-page document outlining a policy vision for the central bank.
You know what this policy vision looks like? The biggest Fed put you could ever imagine in your entire life, because that's what we saw from his previous administration.
I think Congress is going to have something to say about this, don't you?
I mean, this is the reason why I think a lot of people aren't taking it seriously. That said, I read this story last night, and I was looking at this and thinking to myself, people are going to dismiss this as so outlandish as to be unrealistic.
Yeah.
And yet this is one of the main presidential candidates talking about completely overhauling the Fed independence that a lot of people say has been held sacred. What implication does that have in the near term? I would say it just only makes the political discussion around the Fed and when it makes its decisions that much louder.
When Trump was in the White House, they used to call it the presidential put, not the Fed put. It was the presidential put. Anytime the market gapped lower, you sort of heard a change of tone coming out of the White House. The problem with policies like this, and who knows how seriously we should take them, this is a report from the Wall Street Journal. You can be the judge of that. But the problem with initiatives like this, if you start to talk about them seriously, you introduce so much risk into markets that there is no put. It won't be able to support markets. In fact, you might have to hike even more to regain credibility. And we've seen example after that over the years of that, when central banks maybe sort of veer away from their core mandate.
Are you talking about a Liz Truss moment?
Not just talking the UK. Think about Turkey.
Yeah, Turkey,
Erdogan.
sure.
Think about how much Turkey's had to do in response to that. If he didn't get involved, where would policy be? I don't, of course, know the counterfactual, but obviously you've seen difficulty after difficulty with central banks that when they go in this direction, they end up having to hike more than they otherwise would.
And you wonder if this Federal Reserve isn't going to hike in September, even if they have a reason to, in order to avoid some sort of political interference accusations.
I'm sure lots of you have got thoughts on this. Write in, by all means. In the next hour of Bloomberg Surveillance, Annmarie Hordern of John Hancock, John Lieber of Eurasia Group, Mandeep Singh of Bloomberg Intelligence, and a brilliant Gershon Distenfeld of AllianceBernstein. All of that coming up next.
Pillars of this bull market are in place.
The winners are going to keep winning. And the more profitable companies are going to make up a bigger percentage of the S&P 500.
We see more business formation, business dynamism. That's something that had been lacking.
Certainly the market is improving, and we say that, but it's not a hockey stick.
It's not a stock market, it's a market of stocks. That's even more true now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is not a morning for the Bears. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance begins right now. Let's get straight to it. In the pre-market, outperforming, Alphabet absolutely flying. I was going through the numbers yesterday afternoon. It was difficult to find a miss. It was beat after beat on the top and bottom line. Throw in an extra $70 billion buyback, a dividend. Lisa, we're up by 12% in the pre-market.
Which raises this question, again, kind of to Dan Ives' point. How do you bet against a behemoth that has so much cash? They can do the CapEx, they can do the dividend, they can do the share buyback, and still have a fortress balance sheet at a time where their share move last night was akin to something like $250 billion. I mean, to me, it's sort of shocking.
Ad revenue good. Cloud revenue solid. Let's talk about what we didn't see from Meta. What was the big difference, Bramo? We talked about this with Dan Ives earlier. What was the difference between Meta coming out and saying, look, this is what we're spending, and Alphabet and Microsoft doing the same thing with two very different stock price reactions?
Wall Street has not bought the virtual reality headset story, period, full stop. Meta has not given it up. Their name is Meta for the metaverse. The metaverse never came to be in the same kind of way that they thought that it would. People are looking for them to give that up and just go in on what actually is becoming profitable. It is hard to understand why they're doubling down on something that Wall Street collectively has said, this isn't going to work. And that, I think, is a real big distinction.
Well, the tech trade this morning is working perfectly. Alphabet and Microsoft making up more than 10% of the S&P 500. Equity futures absolutely flying. That's the stock market. Need to talk about the bond market as well. So yesterday, two-year yield back through 5%. Briefly, virtually there right now. 10-year yield through 470. So new highs for 2024. 468.78. We've got PCE out a little bit later. I want to bring you a quote from Citi's Andrew Hollenhorst, because I think this is the theme, Lisa, that you and I are both exploring this morning. What would it take? This is what Andrew has to say. We still think markets are mistaken in pricing out cuts entirely this year. Softer growth concerns will be a key factor in Fed consideration to cut, and Q1 GDP details show fading support from fiscal stimulus and softer goods spending. He believes, with the team over at Citi, that it wouldn't take much to reintroduce a conversation about rate cuts this year.
He's not alone. I would argue that actually is the consensus away from the Fed funds future market, because essentially you heard that from Christian Nolting. You're going to hear that from Gershon Distenfeld. You're going to hear that from a lot of guests who come on and still believe the rate cutting cycle will begin this year and possibly even get legs. It raises this question. Is there true weakness under the hood? And if so, is that supportive of risk assets, right? I mean, again, this sort of goes into the chicken or the egg. And again, I think that Bruce Kasman just nailed it when he wrote, that sound that you hear is the narrative breaking. And that essentially is how I feel this morning.
We'll hear Bruce a little bit later this morning talk a whole lot more about that theme. Broader price action, equities doing okay. You've seen bond yields. Let's talk about foreign exchange. Dollar yen at the moment, 156.83, positive by 0.75%. That is Japanese yen weakness on the screen, Bramo, this morning. And yen weakness that this BOJ is struggling to do anything about.
Okay, Mohammed El-Arian corrected me. So, Mohammed, this is for you. You said, actually, the Bank of Japan cares quite a bit about the yen. They're not just taking a whole benign neglect kind of approach. It just is unclear what they can do at this point unless they have some other type of weakening in data from the United States. Again, this just raises a question, what's the breaking point to them? Kit Jukes, I think, talking about 170 as a level highlights just how much angst there is out there.
156.85 on the screen right now. New high for the session, for the month, for the year, for the last 4 decades. Coming up, Annmarie Hordern of John Hancock and tech driving stocks higher. John Lieber of Eurasia as Secretary Blinken meets Xi in Beijing, and Gershon Distenfeld of AllianceBernstein looking for a rally in bonds. We begin with our top story this morning. Blockbuster tech earnings driving futures higher. Annmarie Hordern of John Hancock writing this: we have been married to tech stocks for years. It's been a successful relationship, but it may be time to date more cyclical parts of the market during this period of re-accelerating inflation growth. Annmarie, let's talk about why you want to cheat on something that is treating you so well this morning.
Well, after last night's earnings results, the narrative has shifted a little bit. It almost feels like you're kind of married to Mr. Perfect here, right? We know your company's doing great. Earnings across tech and communications services coming in around 30 to 40%, but the stocks are starting to get a little flashy. We liked them more a few months ago when they were a bit more humble. So it's really about, thinking about still owning these stocks. We're still in a relationship, but you might want to look around a little bit to see who's the next up and comer.
Are you saying there's red flags?
Not necessarily around the fundamentals. I mean, there's nothing wrong with tech. The earnings are great. It ranks really high on our quality metrics, things like return on equity. These companies have a ton of cash. It's just everybody's in love with them. Everybody wants to be married to them. So a lot of that's already been reflected in the price. We want to diversify away from that and own things that are actually trading on sale. And as the economy continues to chug along here, we think areas on the value complex, specifically the energy sector, deserves a look in portfolios.
If Mr. Perfect is Mr. Perfect, why leave him? I mean, honestly, you have to realize that at a certain point, if we're not going to get rate cuts, if it's not going to look better elsewhere, is it just sort of to see what else is out there for the sake of seeing what else is out there, but Mr. Perfect ultimately is the one to be with?
I got to be careful with this analogy to make sure my husband's not listening to it. But you know how these marriages go after a little while. You guys know we've been married to tech for a long time, and we're going to continue to have that relationship. There's no doubt about it, especially given our preference for quality and given our preference for U.S. equities over international. We simply have the best earnings here in the United States, and a lot of that's been driven by tech. So it's not about abandoning the relationship. It's just about looking around a little bit to see what areas of the market actually have been left in the dust and might benefit from this modest reacceleration we're seeing in economic growth and demand globally. And we think that on the value side, those stocks have been ignored.
I'm going to have to bite my tongue in taking this analogy further, so I will leave that there for now. I am curious, though, at what point this idea of diversification is really predicated on a rate-cutting cycle, even if it only is one that starts this year. Does that idea of diversification working fail if you get the idea of no rate cuts this year and potentially much higher rates for longer?
Yeah, I don't think so. I mean, the idea that we're looking at is that, we had this massive momentum Fed pivot party driven rally, and really tech and growth were the biggest beneficiaries of that. At one point, the S&P 500 growth index was trading at a 45% premium to its long-term average. And really a lot of that was predicated on the idea that growth was slowing and that rates were going to get cut. The higher for longer narrative to us really speaks to the idea of diversification and seeing some participation from areas that really did not participate in that momentum-driven pivot party rally. So I think, if in a higher for longer environment, which it looks like we're here to stay, we do think that more cyclical areas deserve a look in portfolios.
Well, let's have a look at energy this morning. So Exxon came out with earnings in the last hour or so. EPS in at $2.06, the estimate $2.19. It's a small miss. The stock is a little bit lower in the pre-market. Is that where you want to be?
Yeah, we do think it looks like, energy can do well here. Those companies in general have a lot more capital discipline. For years, energy companies were just pumping more money into producing more oil. And now there's a lot more uses of that capital, whether it's CapEx, whether it's investment in, or whether it's producing dividends for investors. So we think, certainly the portfolio managers that we work with at John Hancock have done a great job being active in that space. And it's, feels like a little bit of a 2022 playbook right now with the stagflation narrative coming to the forefront. And of course, we know that energy was really the only winner that year in addition to the US dollar and cash. And we want to be mindful of that.
How much weight do you put on the stagflation narrative of yesterday?
I think it's, there's whiffs of it, John. Obviously the first reaction, and it felt like a roller coaster ride yesterday as everybody started digging further into the GDP data and deciding it wasn't really all that bad and inflation wasn't all that bad. I think that was the gut reaction. The missing piece to this, the twist on the stagflation argument is that the labor market is so resilient. Everyone was focused on GDP yesterday, but initial claims came in at 207,000. That is like the jobs market saying there's nothing to see here. Of course, the unemployment rate's still well below 4%. So the economy's doing okay. You look under the hood at GDP, final demand was really robust. Consumer and business spending still doing well. There were some pieces of the pie that weren't so great. The economy's chugging along here. So I think we're still not at stagflation yet, but there's kind of some whiffs in the air.
I'm trying to just imagine your investing life. So you're married to Mr. Perfect. You're dating the hot thing, which is commodities. How often do you go visit the parents, which is the bond market? I mean, basically, where does that fit in to this whole equation?
Yeah, so that we've continued to emphasize bonds and portfolios. The fact that you can get paid to wait in this never-ending late cycle environment to us is really attractive. We think we'll continue to see some chop in rates from here as we look at how long it's taking to get back down to the Fed's 2% target in inflation, growth picking up again modestly here. It's not great, but the fact that you can earn 5+% in income owning the aggregate bond index, that's something that we haven't been able to say in a really long time. So we think it makes sense to lean into bonds, get paid to wait, because this cycle likely ends the way that it always does, which something will break. It's just really hard to see that right now.
Lisa, who are the kids? Foreign exchange, the Japanese yen. Where's this going?
Bitcoin,
crypto.
yeah, NFTs.
Oh, you're going to make friends this morning.
Carry on. Well, I love it. Dating the hot thing, commodities. How long can that last? That's sort of what everybody loves.
He's too perfect.
What a complaint. I want to go into that really further.
That up?
Yeah, exactly.
He's
too perfect, which means what exactly? That why don't you want him to,
Men the world over want to know what is too perfect.
And honestly, and babysit, frankly, crypto.
Emily, we're going to go. Emily Rowland.
There you go.
John Hancock, this is your fault. Thank you. I like the parents as the bond market.
Well,
everyone in fixed income this morning agrees with you.
100%.
Because, everyone in fixed income looks down at every other asset class.
Totally, and tells them that they just don't understand. They need to get responsible and balance their books, understand their cash flow. And essentially, the stock market is saying, just live a little. Risk a little.
Sure.
Invest a little bit in the future.
We need an intervention in the FX market. This is what you do with the kids every now and again, right? OK, this works. This isn't even a quiet news day. I don't know what we're doing. Equity futures right now on the S&P 500 up by 0.8%. Let's get you some of that news elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Testimony resumes this morning in the hush money trial of the former President Donald Trump. It's now the defense's turn to question former National Enquirer publisher David Pecker. He was the prosecution's first witness, during which he described helping to bury embarrassing stories Trump feared would hurt his campaign. Huawei's latest smartphone carries a version of a processor that had alarmed U.S. officials. It was revealed last year, during which that Washington thought the advanced made-in-China processor was beyond China's capabilities. Now, the U.S. is weighing additional sanctions to contain Huawei and China's chip industry more broadly. Now, as for the company itself, its new phone sold out within 2 days of its launch, according to checks done by Jefferies. Blackstone's head of credit and insurance sees a further slowdown coming for corporates, which means they're going to need extensions of loans as maturity walls approach. And he says Blackstone is ready to take advantage of it.
Certain companies will need a bit more runway, will need a bit more of an extension of, say, their first lien unitranche paper. They may need a piece of mezzanine debt or preferred security. So we're getting ready for that. I don't think you'll see a massive slowdown, but you'll see a slowing top line and bottom line that we've kind of started to see play out a little bit here.
Gilles Dillard spoke with me exclusively in his first interview since taking the role. And that's your Bloomberg Brief. John.
Danny, thank you. We'll catch up with Danny again in about 30 minutes' time. Just on the tech calendar, 2 dates for you. So Tuesday, you're going to hear from Amazon. 2 days later, Thursday, you will hear from Apple. That's the big focus for tech earnings, sandwiching a Federal Reserve decision on Wednesday. Up next on the programme, Blinken breaking ground with China.
The United States is very clear-eyed about the challenges posed by the PRC and about our competing visions for the future. We want China's economy to grow, but the way China grows matters.
More on the conversation between the Secretary of State and the leader of China up next on the programme, live from New York. Good morning.
Wednesday. The Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, The Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Here's a picture of two names that make up roughly 10% of the S&P 500. This is what those two names are doing. Microsoft's up by more than 4%. Alphabet is flying by more than 12%. And when you put that together, you get this. Equity futures doing nicely on the S&P. Switch up the board. Futures look like this morning. S&P 500 futures up by more than 0.75%. Yields a little bit lower, down 2 basis points, 468.78. With economic data just around a corner. PCE, the Fed's preferred inflation gauge, at 8:30 Eastern Time. Under surveillance this morning, Blinken breaking ground with China.
The United States is very clear-eyed about the challenges posed by the PRC and about our competing visions for the future. In my discussions today, I reiterated our serious concern about the PRC providing components that are powering Russia's brutal war of aggression against Ukraine. I made clear that if China does not address this problem, we will. America's actions are not aimed at holding back China's development, nor are we decoupling our economies. We want China's economy to grow, but the way China grows matters.
Here's the latest. Secretary Blinken meeting with Chinese President Xi Jinping in Beijing. The two discussing everything from Russia to Iran, but not TikTok. Joining us now to discuss is John Lieber of Eurasia Group. John, of course, there was a meeting between the Secretary of State and the leader of China, also a meeting between the China Foreign Minister Wang Yi, who accused the US of taking endless measures to suppress China's economy. This was a conversation of more than 5 hours over a working lunch. John, do you think the United States has managed to get its point of view across, whereby the Chinese will change their mind about some of this language? It's not fair competition, but containment. It's not removing risks, but creating risks.
I mean, the language isn't really the problem here. You've got two countries that are clearly on a continued collision course, that are going to continue to be each other's antagonists, both in the economic sphere, but also the geopolitical sphere. So, these kinds of conversations should probably be seen as positive just because they're happening. But the real issues here are what Blinken said in his speech just there, that the Chinese continue to support Russian material in its war against Ukraine, that they're buying this Iranian oil that the U.S. is okay with for now, but would probably prefer to get the Iranian oil off the market, particularly if Donald Trump comes back in. And you've got this ongoing threat of tech competition, which is sort of looming in the background of the relationship, where a lot of American companies are trying to decouple and divest away from China because of the increased threat they perceive, both in the operating environment in China, but also America's politicians' very hawkish turn towards China that could lead potentially to a sudden stop in relations at some point down the road.
John, let's sit on geopolitics then. The amount of influence that Beijing has over Iran, has over Russia, and the amount of influence the US has over China to do something about it. How much influence do both sides have?
I mean, the US's influence here comes in the form of sanctions. They could sanction Chinese entities that are buying Iranian oil. They could sanction more Chinese entities that are supplying dual-use goods to Russia. They're not yet, in order to preserve the relationship and maintain gas prices, but they have the powers to do so. I think the Chinese influence over those two countries matters, and there's probably quite a few things going on behind the scenes that we don't exactly know about in terms of how they're supporting Russia, how they're supporting Iran, potentially how they're supporting the regime in Venezuela. There's just things we don't know. And and that material support plus the strategic support probably helps those regimes counter American influence, which is in some ways helpful for the Chinese in their long-term goals.
John, how much do you think that this administration in China is more willing to work with President Biden because they prefer him over the alternative?
I think they've had a decent relationship with Biden, but it hasn't been all great. And if you look at the trajectory of the relationship under Biden compared to President Trump, it's largely the same. Biden did nothing to reduce the tariff complex that was created by the Trump administration, and he's gone significantly further than the Trump administration on cutting off Chinese access to U.S. semiconductors and other advanced technologies, and potentially is setting up to do even more in a second Biden administration. Now, the Trump administration is probably going to do a lot of that same stuff. So I sort of wonder from the Chinese perspective if they really care which of these men wins the White House in November. One thing the Biden administration has done a little bit differently has been a lot more multilateral. They've been able to align a lot of U.S. allies in favor of their initiatives. The Trump administration struggled to do that a little bit more, but we have now this precedent set where we've got this increasing kind of tech competition, this tech Cold War happening between these two countries that's likely to continue no matter who wins in November.
We talk about TikTok. They didn't discuss it, and yet the specter kind of hangs over a lot of American businesses as well. When they try to figure out what kind of retaliation can they expect from Xi Jinping, from China, if there is some sort of TikTok ban or forced divestment. Do you see this as something that Xi Jinping is willing to do to really divorce the relationship between the United States businesses and China even more?
Well, on the issue of TikTok, to me, it's really interesting. The news yesterday indicates that ByteDance is willing to shut down TikTok operations in the U.S. if they're forced to divest because of the fact that that operation is such a small share of their overall profits. It's also interesting to note that the retaliation in many ways has already occurred. I mean, China has been harassing U.S. tech companies operating inside the country for years. Google, Facebook, they don't really compete, if they're in there at all, on a level playing field. There is a threat for things like Apple's operation or Tesla or other big U.S. companies, but none of those really rise to the level of being geopolitically important to the United States. And what I would expect to see are further decoupling and further bans of individual companies in both countries in the coming months and years.
What do you make of the increased action in the South China Sea? The fact that people are talking about some potential incursion on Taiwan in the foreseeable future. Do you think that China has the appetite to do that at a time where its economy isn't growing as much as they'd like?
We think something happened on the Taiwanese on the island of Taiwan is very unlikely. It just seems not like it's in China's interest to invade. It seems like they have a lot to lose, and if things go wrong, they're going to set themselves back significantly, both economically, but also diplomatically and geopolitically. However, there are a lot of sort of gray zone actions that they could take short of an actual incursion, including a blockade, which is not on the table right now, but that would be a significant challenge for Taiwan. They could also start doing more things to harass Taiwanese shipments going to the mainland or going to the United States, which could end up having a massive disruptive effect on commerce, even if the Chinese recognize what a huge mistake it would be to try to take Taiwan back by force right now.
This is a bigger question, I think, for the Europeans, John. I believe that someone notable was talking about this overnight. It might have been the NATO Secretary General, I forget, so forgive me. But comments about whether Europeans were making the same mistake with China that they made ultimately with Russia and relying too much on profits out of China. John, do they run that risk? And how big is that risk for the Europeans?
Absolutely. And look at who the leading edge is in both cases. It's Germany. So the Germans have done a lot of work in order to integrate their industrial base with China. China is an important market, and it's an important manufacturing hub for Germany as well. And you've got Olaf Scholz, who seems like he's out of step with the rest of the West and the rest of the Europeans in wanting to deepen and continue that relationship. So that's entirely possible. I actually think one of the interesting things coming out of a potential second Trump administration would be this increasing alienation between the Europeans and the United States on the issue of China. But, we could have very different political leadership in Germany in a couple of years that may change course here. So there's a big risk that they're running right now of getting too reliant on China and losing one of their most important trading and economic partners in the United States.
What a moment. John, just wonderful to catch up with you, sir. Thank you. John Lieber there of Eurasia Group, breaking down some of these issues. Question I wanted to ask Bramo, is basically how divided or united Europe is on this matter. When you hear from Scholz, do you hear something different from Macron?
I think the answer has been yes, pretty much across the board. And the question is just how alone is Germany at a time where they need it? Their economy is the sick man of Europe, right? This is what people are saying, as opposed to sort of the strong suit in the closet. I mean, this is the question. I know my analogies are just terrible today.
Long week, Bramo.
But it's really, to me, this is actually a really big deal, because how does Germany restart growth if they don't have China And if they do have China, do they still have the United States down the line?
Yeah, the model's broken. Said it a few times, haven't we? It's very broken. Coming up on this programme, something that's working. Shares of Alphabet and Microsoft absolutely flying in the pre-market. Blockbuster earnings report, driving these stocks higher by 4% on Microsoft, up more than 12% on Alphabet. We'll catch up with Mandeep Singh of Bloomberg Intelligence next. Heading towards a week of gains on the S&P 500, up by 0.75% on the S&P. On the Nasdaq 100, up by 1%. Did I call it the S&P 300 then?
It's you know what? It's the S&P 3.
I'm so tired. Did
it's
I say
the S&P
that?
3.
Okay.
But honestly,
did I actually say that? I don't even remember now.
I don't know.
Okay, forget it. Let's get to the bond market.
It's
We
a
know more
strong
about
suit
bonds anyway.
in the great closet.
All right, fixed income. I've got no idea what's happening. Did I say that? Don't know. 4.99 on a 2-year. 10-year down 2 basis points, 4.68. Heading towards 5 weeks of gains on a 10-year yield. Just an amazing stretch. I think the longest going back to October, breaking through 470 yesterday. I love Jim Reed over at Deutsche Bank. He put out a note moments ago. He said, hard, soft, no stag.
Yes.
It's been hard landing, soft landing, no landing, and now, after one data point yesterday, it's stagflation.
It speaks to, again, the lack of conviction that we've been talking about extensively. Honestly, this has been a dramatic month. The past 4 weeks has been pricing out rate cuts until December for the first time. I just don't know that whether the rest of the market has bought this. Is this really the situation? Is Emily Rowland still having conviction about, cheating on Mr. Perfect if you really don't believe that there are going to be rate cuts this year? That's really one of the key questions today.
Just amazing how the 2 years been glued in and around 5% at the front end of the curve over the last few weeks or so. Let's turn to foreign exchange. On the euro at the moment, just about unchanged on the session. We're trading at 107.29. Lots of things to say about dollar yen at 156.71. But allow me to say this about the US dollar. Michael Hartnett of Bank of America this morning. The dollar rip in Q2. Investors hedging the Fed hike risk, and US needs dollar strength to counter inflation. This is bad news for EM. The latest from Hartnett this morning.
And basically, he says that Mr. Perfect is the place to be with until you do see some sort of situation with rates bringing some of the activity lower, and suddenly you get the prospect of rate cuts again. Essentially, until you really get belief in rate cuts and see the whites of their eyes, you got to bet on Mr. Perfect.
Don't cheat on Mr. Perfect seems to be the takeaway here. Don't cheat. Under surveillance this morning, the Bank of Japan keeping rates on hold, and the country's finance minister reiterating they will respond appropriately to foreign exchange moves. The yen pushing through 156 against the dollar. It's been a volatile day, 157 in sight. And I say volatile, you can see it on the screen. Around 4 a.m. Eastern time, which is when some of us sort of like are on our way to work, unfortunately, we gapped lower on dollar yen. And there was this talk that maybe we've had some intervention. We snapped back very quickly.
And the issue is that really this becomes a credibility issue. What can they actually do? I mean, ultimately, can you imagine they throw $60 billion at this and it goes nowhere? Mohamed El-Erian saying they do care. They care quite a bit. But you need a mix of both intervention on the FX side as well as a policy shift to the Bank of Japan side. And you didn't hear that at all. In fact, Governor Ueda has talked extensively about how they want to see personal consumption continue to be strong, that they want to see a greater degree of inflation. This didn't seem like a Bank of Japan ready to normalize with any kind of aggressive policy shift in the next couple of months.
Not for us to say they don't care. They've told us they care. There's been enough verbal intervention over the last few weeks or so to suggest that they do. I think you're on the right line of things when you raised it earlier this week, that ultimately, if you're a policymaker, what do you care most about? You care most about preserving credibility of an institution. And to your point earlier this week, if you come in and it doesn't work and you sacrifice credibility over that, if you can really think about the perfect time to come in and intervene, it would be if you got a downside surprise on US data, you had that dollar weakness kick through and you just slapped it down even more and really forced through a stronger Japanese yen. That would be the time to do it, to exacerbate the trend. I think going against this right now, just increasingly difficult, which would be, why we've gone through 2, 3, 4, 5, 6, and we're looking at 157 and they haven't done anything yet.
So in 56 minutes and 30 seconds, just wait. If we do get a softer than expected PCE print, the core metric that the Fed likes to use to gauge inflation in the United States, watch for a very volatile move, in particular in the dollar-yen cross.
I'm not sure how much scope there is for a downside surprise on PCE, given that most economists sort of know, basically with the information we have so far, where that's going to land at 8:30, but sure.
Probably not, which, again, We used to keep wondering how high the bar is anyway, but, keep talking about it.
That currency pair positive by 0.7%. I think we've all got it on our Bloomberg terminal, just sort of sat there staring at the chart every morning. A little under an hour away, we'll get a fresh dose of US inflation data with the core PCE deflator due at 8:30 Eastern Time. Traders watching closely for hints of stagflation after yesterday's GDP data trailed forecast. It's amazing how quickly everyone's talking about a different theme. Stagflation, a whisper of it after yesterday's data.
Basically, nobody was talking about the potential for any kind of weakness. I actually think that more than core PCE, personal income and personal spending is going to be more important, because that was the area that missed yesterday in the GDP numbers. If we see personal spending come in hot, well, all of a sudden stags out and we're back to no landing. And so all of a sudden we go back to this idea that you do have just pure strength with no asterisks around the edges. To me, that's going to be a bigger number.
Big moves in this market, pre-market. Let's talk about them. Microsoft and Alphabet rising big time. Both companies blowing past earnings estimates yesterday afternoon, fueled in part by booming use of artificial intelligence. Tech giants are jostling for dominance in AI, with Microsoft and Alphabet's results coming in stark contrast to what we saw Meta do in trading yesterday. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, you said it. These two are the big ones this week. Let's talk about the numbers. Can we start with Alphabet? Alphabet, earlier in the quarter, struggles. Gemini, screw up. Big challenge to the core part of this business. And here we are up by more than 10% of the pre-market. What's going on?
Yeah, I mean, the overhang from the Gemini screw-up has been cleared now, and they showed that in the search results. I mean, the 32% operating margin we saw in the quarter was driven mostly by search. Cloud and YouTube are great, $100 billion combined businesses growing at almost mid-25%. So you could argue, you could give it a $1 trillion market cap just for those two businesses. And search, I mean, for a company like Google with a $200 billion business that they can grow at mid-teens, that tells you incremental margin of 75% in search. That tells you something, how much pricing power they have. And that's what they are doing now, flexing that muscle.
Let's go to CapEx. I think they doubled it. They doubled CapEx from last year, which is pretty amazing.
Yeah. Mm-hmm. And look, I think what they're doing is they're using that CapEx to grow the cloud business. So the difference between Meta boosting their CapEx versus Alphabet is pretty much using that CapEx for cloud capacity. That's showing up in the numbers. Cloud business actually accelerated to 28%. And what we learned from Microsoft is AI services, the cloud component where they run the infrastructure, actually contributed 7 percentage points to growth. So it's pretty similar to Alphabet, although they didn't break it out, and that just shows you how much power they have.
This is a big move of more than 10%. Lisa was talking about at one point it being an extra $250 billion on the market cap, which when you think about it is kind of ridiculous. I mean, seriously, do you think there are trends here that we can extrapolate out beyond the next quarter, beyond the quarter after that, into the next few years?
I mean, this is probably a one-time move. I think it was right there in terms of everyone to see how much power they have with the three independent businesses. And I would argue even Waymo. It's an optionality in their portfolio. If robotaxis is a thing with Elon Musk when he launches in August, Waymo is far ahead in terms of the autonomous fleet, even though they don't have as many cars. And I would argue that business is worth a lot as well. So clearly, with Alphabet, when you look at the sum of the parts, I mean, Alphabet plus YouTube at $1 trillion and Score Search at least more than $1 trillion in market cap, Waymo optionality, this business was undervalued for sure.
You talk about $1 trillion here, $1 trillion there, all of a sudden you're talking about real money. Are they just making money outright that wasn't to be made elsewhere? Or are they taking share from, say, AWS of Amazon?
I think on the cloud side, given the numbers we saw from Microsoft with 31% Azure growth and Google growing 28%, Amazon has a $97 billion run rate in cloud. It's the largest cloud player, and it was growing at low teens. So if they don't show that kind of acceleration where they are close to 20%, they're probably losing share right now, and for good reasons. They don't have the NVIDIA GPUs to deploy on their cloud. So that's part of the reason. They don't have their own foundational model. They are partnering, and that's where I think market needs more clarity.
If the market gets the clarity that confirms your suspicion, how violent could this move be given the fact that the AWS platform has been the profit driver for Amazon?
Yeah, and ads as well. So ads is another $50 billion business that Amazon has been able to really curate over the last few years. And ad side actually may do quite well, given what we saw from Meta and Google search. I mean, Amazon is quite formidable with Google, with their own search, and they don't have the Chinese advertiser exposure that we were talking about with Meta, to an extent with Google, less so. Amazon doesn't have any of that. It's all the small businesses that advertise on Amazon. So the ad side may be better than the cloud side, but clearly, to your point, cloud is the bigger business. It's a profit driver. And if the growth doesn't accelerate, I think that may be an overhang on the stock.
Do you sense any e-commerce fatigue over at Amazon? I feel like attitudes towards that side of the business are shifting pretty quickly.
Well, so on the e-commerce side, what they're doing is really making the Prime bundle kind of indispensable. They're adding more services. They're adding grocery delivery now. So they're really making that sticky. And that's always been Amazon's playbook in terms of driving recurring subscription revenue.
I hate buying clothes on Amazon. I've got to be honest.
I think people are starting to hate buying everything on Amazon.
Yeah, well, it's sort of frustrating if you don't get exactly what you want. They want the experience of existing in this real physical world.
You pay for Prime, and now it's sort of like you have to pay extra for Prime Video for no ads. You didn't have to used to do that. And now I think, did I hear earlier this week there's going to be a new thing you have to pay for delivery through the year when you already pay for Prime? I don't understand that either.
All of this they can work through. I am wondering.
It's the one bundle you can't get rid of. That's their play. You can just get rid of all the other subscriptions.
Haven't everyone else upped their e-commerce game to such an extent that maybe you could live without it now? Aren't we getting closer to that?
Well, again, that's why they package so many features. Video, part of giving you video and grocery delivery and e-commerce and all sorts of other things is that is the one bundle. If you have to really cut back, cut on your one-off subscriptions. You can't get rid of your Amazon bundle.
Dan Ives was on earlier, and he was saying with all the tech names, what he's watching for the next iteration is acquisitions. And he thinks that the likes of Google and Microsoft are really going to amp up that engine. I don't know about Amazon. They've already done that quite a bit. Do you see that as possible, given the environment we're currently in?
Very unlikely, unless, TikTok, which is up for sale, can be bought by, let's say, a Google. I mean, Google obviously doesn't have its own social media, like YouTube is the closest that comes. And maybe that's a potential acquisition if the regulators let it happen. But I don't think that will fly.
Well, that's what I was going to ask.
Yeah.
I mean, how much can this be a base case? And if they don't do that, what do they do with their fortress of cash? Just T-bills and chill?
And they announce a dividend. So now the focus will be on Amazon announcing a dividend because that's the only one among the Mag 6 not to have a dividend. So I think next week you probably are, again...
What do you make of the maturing of these companies offering dividends? Things like Alphabet. What do you make of that? How important is that?
I mean, when you're generating 80 to 90 billion in free cash flow, buybacks, yes, you can do that when you want to do that. But having a dividend just attracts more long-term shareholders, different kind of shareholders, and it's more symbolic. I mean, the dividend yield is less than 1%, so it's not as if, they are right up there with other sectors.
I always think about some of these companies, they're so big now. What is Google doing owning Waymo? Why do they own that? Why don't they just sell that?
Because their argument is AI is everywhere, and that's what they're doing, infusing AI in all their products, whether it's search, cloud, YouTube, Waymo.
It's all the data. It's all the data. They're collecting data on every aspect of our lives. And the more data they can really collect and own, the more their artificial intelligence models are going to be best.
The social media platform, just call up Elon and do a swap, Waymo for a Twitter. I'm not sure one is worth the other. But
is that really?
He's using X for Tesla's AI.
Hey, possibly. Making deals this morning, Mandeep. Mandeep Singh there of Bloomberg Intelligence. Deals, as we know, that with this administration will not go through anyway. So it's a sort of a fruitless conversation. Equity futures right now on this S&P, positive by 0.7%. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Testimony resumes this morning in the hush money trial of the former President Donald Trump. Now it's the defense's turn to question the former National Enquirer publisher David Pecker. He was the prosecution's first witness and described helping to bury embarrassing stories that Trump feared would hurt his campaign. The FTC is alleging that Amazon founder Jeff Bezos, CEO Andy Jassy, and other senior leaders destroyed business-related text messages. The FTC said that between April 2019 and May 2022, they texted using Signal with a disappearing message function. The filing also expands from other antitrust allegations from last fall. An Amazon spokesperson called the FTC's allegations, quote, baseless. BHP's bid for Anglo is rippling through copper markets. The metal hit $10,000 a ton, just backing off of that now, but for the first time in 2 years. That deal underscores supply issues among the metal, that miners would rather buy a rival than build entirely new projects. BMO's Colin Hamilton said that it tells you building the stuff is just too expensive, while Blackstone says that prices need to hit $12,000 before new mines make sense to be built. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate the update. We'll catch up with Danny again in about 30 minutes' time. Up next on the program, the case for buying bonds.
At the end of the day, the yield is what matters. The yield is what wins. And yield remaining high, I think, really continues to act as a tailwind for the bond market.
We'll catch up with one of our favorites next, Gershon Distenfeld of AB, just around the corner. Equities positive by 0.75% on the S&P 500. There is a lift in this market. We are about 43 minutes away from economic data in America. Yields are lower by 2 basis points. The 10-year, 468.37. Under surveillance this morning, the case for buying bonds.
Rates being higher is the story here. If you rewind the clock, January, November last year, there was so much bullishness around rate cuts. And I actually felt that was really the worst thing from a bond market perspective, as I think ultimately at the end of the day, the yield is what matters. The yield is what wins, and yield remaining high, I think, really continues to act as a tailwind for the bond market.
Here's the latest this morning. Yields near year-to-date highs after economic data pushed back expectations for Fed rate cuts. Gershon Distenfeld of AllianceBernstein writing this. Investors are getting a second chance to, quote, not miss the rally in fixed income. At some point later this year, the markets will again become convinced that the Fed is going to start to cut, and we will, in all likelihood, have another very sharp rally in yields. Gershon now joins us for more. Gershon, wonderful to catch up with you. It's a second chance. The first chance expired in October. Can you talk to me about how different this moment is compared to that moment just several months ago?
Actually, I don't think it's that different, John, though. I have to point out something. About a half hour ago, you made fun of fixed income investors. You said that we think that we know more than other investors. we don't think it, John. We know it to be true. It's just a fact. Accept it.
You can answer the question now. With that said,
yes,
I'm on board. I understand. No argument here.
Yeah, I actually don't think it's that different. History suggests that the yield starts to rally. Actually, bonds of all stripes have very strong returns about 3 to 6 months before the Fed starts cutting rates. You have to remember, back in November, the market was convinced the Fed was going to start to cut around now. We obviously know there are good reasons why they're not going to. I can't tell you whether they're going to start to cut in September, December, or sometime in 2025. I think those are all possibilities. But at some point, we always focus on the latest data. At some point, the market's going to recognize you can't keep rates up here forever. The Fed's going to start to cut, and you're going to have a massive rally. Only 3 months ago, we were answering questions from investors. Did we miss the fixed income rally? And we kind of had to say, yeah, you probably did miss a lot of it, maybe all of it. And investors now are getting a second chance.
Gershon, something you view that I think is really interesting, your perspective on market pricing. When you look at market pricing for Fed funds, you call it an average of everything. That's the way you look at this. And we often sit here in the media, and I think a lot of people in markets are guilty of the same thing. They'll say, we're now pricing in just one cut from the Federal Reserve. And you say that's not what this is. It's an average of everything. And you think the average of everything right now is actually the least likely outcome. Can you explain that a little bit more?
Yeah, let's start with a year ago, right? A year ago, the market was pricing in 3 or 4 cuts by now, and we've gotten 0. Does that mean the market was wrong? Not necessarily. There was some chance that things would weaken considerably and you would have gotten, 6, 7, 8 cuts by now. Or there was some chance, as actually happened, that inflation would be sticky and the Fed wouldn't cut at all. I think it's the same thing going forward. I would expect, 1 to 2 cuts is probably a very unlikely scenario. Either, right, the data will get, the economic data will get quite a bit worse and inflation will be whatever it is, but the Fed will feel like we just have to cut and they'll cut 4, 5, 6 times. Or, right, inflation will be sticky, economy will be fine, and the Fed will just hold off until 2025. I think those 2 tails are actually more likely than that 7.
If you love treasuries because you believe in the weakening tail, can you love credit?
Yeah, I think you can love both. Spreads are tight in credit, but they're justifiably tight. As I've said before on this show, right, companies have spent the past 3 or 4 years post-COVID, paying down debt. Leverage has come down. They weren't making a ton of acquisitions or buying back shares or spending on capital expenditures. So companies are actually in pretty good shape. And the quality of the credit market, particularly the U.S. high yield market, has never been better. Many more double Bs, many fewer triple Cs. And that's relevant because almost all defaults, almost 80% come from triple Cs. So tight spreads are justified. And as my esteemed friend, Greg Peters, said that you had at the outset there, yields matter. Yields matter a lot. Yields matter a lot more than spreads. You could have spreads widen, as we expect they might as Treasury yields come down, but still have very, very strong returns. So we'd be advocates kind of all levels of fixed income right now, Treasuries and credit.
Have you noticed a different type of buyer coming into the fixed income market as suddenly yield does matter and suddenly people are realizing they might have a sure bet on a 6, 7, 8% return than they did in equities? It's sort of a reverse of what we saw for so many years.
Yeah, Lisa, I think, look, I'm not an equity expert, even though, as I said, I know more than the equity people. That's a joke.
Thank you.
Most equity strategists are telling you you're not going to get to 10, 11% you've gotten historically. You should more like 6 to 8%, and credit's going to be very competitive with that. Starting with an 8% yield, I think even if you have the historical loss rate of 2%, that still gets you 6. We think it's going to be a little bit lower. We think 6 to 7 is probably the right level. The one thing that high yield and credit is very consistent on is in down markets, it goes down a lot less than equities. I come across people sometimes, they'll tell me, I'm scared of high yield, whatever. Defaults are going up, tight spreads, liquidity, whatever reason they come up with. And I say, okay, well, what % of your portfolio do you have in equities? And the answer, of course, is always, 50, 60, 70. And I very politely say, I just want to inform you that historically speaking, every time high yield has sold off meaningfully, equities have sold off more. When I say every time, high yield has had a drawdown of 5% or more 20 times in the past 40 years. So about every other year. Every single time, without exception, during that drawdown, equities did worse. S&P, MSCI World, whatever you want to look at. Now, is it possible? We should all be the first to say that things that have not happened in markets can happen in markets and do happen. Is there a scenario where equities do well and credit does poorly? I'm sure there's a scenario, but it's probably not a very good investment strategy to bet against something that's literally never happened. So I think investors should stop thinking about high yield as a way to take up the risk in your fixed income portfolio, look at it more holistically, and maybe take some chips off the equity side, which you've done really well, and put it into high yield. Definitely reduce your risk and downside, and maybe not even give up return.
So that's an argument for resilience, putting more resilience into the portfolio, Gershon. When you make that argument, are they open to it?
I think it's difficult for a lot of investors because it depends on the type of institution, but a lot are very segregated among high yield and fixed income. I sat on the board, on the investment committee of a nonprofit, and I've made some inroads there, even though I'm on the fixed income subcommittee. But we find many investors still segregate things. That's the reason, by the way, that high yield has about the best Sharpe ratio of any asset class there is. In fact, people don't recognize this. I'm not suggesting this is really practical, but had you levered high yield to the same risk level of equities over the past 40 years, you actually would have had a higher return. So I think people under-allocate to high yield specifically because they look at it in that fixed income lens. And to invest in high yield, they're like, wait, why do I have fixed income? It's to protect me to do well when equities are selling off. And you start saying, okay, put some high yield in there, and all of a sudden, well, wait a second, that doesn't do so well when equities sell off. I don't want that in my portfolio. Where I think the right way to look at it, but to your point, it's hard for many institutions to do that, is to look at the entire portfolio and realize that high yield really acts more as a low volatility equity service.
Gershon, just quickly here, we just have about a minute. What about the other tail, the idea of not cutting rates at all? What does that do to this thesis?
It just prolongs it. I have a hard time, obviously if the 10-year got to 5%, it wouldn't shock me. But if I look very simplistically, right, inflation, the Fed wants to get to 2%. The market's coming around to saying, look, 30-year tips break-evens are about 2.4. We've long thought 2.5 just because of some of the secular trends of deglobalization, rise of populism. So you get to 2.5 on long-term inflation. And real rates have averaged 175 basis points over the past century. So I'm a very simple person. My simple math, 2.5 plus 1 3/4 is 4 1/4. And by the way, if you expect a slowdown, as we kind of do, that should come in a little bit, maybe more towards 4%. So I don't know how we get there, but I do look out a couple years from now and see, Fed funds will be somewhere around 3. You'll have a normal 2s10 slope of about 100, and that'll put the longer end of the curve around 4%. So I don't know what's going to happen in the next 2 months, but in the next year or two, yields are going to go lower.
Gershon, love this. Fixed income defender, Gershon Distenfelder, co-head of fixed income at AP. Gershon, good to catch up, buddy. Thank you. The amount of people in bonds that wrote in as soon as Gershon started that rant. Long live bonds. Kevin Giddish, remember Kevin? Happy birthday, Kevin. Thanks for writing in. Kevin writes in, long live bonds. I think everyone in the bond market feels that way about their asset class.
The parents of the room are saying, actually, we're the star. Finally, you can come back and appreciate who we are as people.
We're the smart ones. Isn't that it?
We're the smart ones, and we can provide you excitement.
Sure. Great. Can you? From New York, the third hour of Bloomberg Surveillance. Up next.
I don't see why the Fed would be rushing to be cutting rates into an environment where inflation is still sticky. That was true 3 months ago. It's true today.
They want to be a little bit cautious about how sanguine they are on the number of cuts that they will be able to deliver this year.
Whether it's 1 cut, 2 cuts, 3 cuts, we don't care because it's the start of a bigger cycle.
If we do, in fact, hit some kind of economic speed bump or a recession, there's actually scope for rate cuts.
The Fed's got to try to buy time here. They're between a rock and a hard place.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
30 minutes away from economic data in America. The third hour of Bloomberg Surveillance begins right now. Good morning. Good morning to you all. New highs for 2024 in the bond market. Let's get straight to that bond market this morning. On a 2-year, on a 10-year. Yesterday, back through 5% at the front end of the curve. On a 10-year, through 470. Back now by 2 basis points to 468.16. On a 2-year, 499.54. Bramo, the data, 29 minutes away.
And what's going to be more important? Core PCE deflator, which is the key inflation metric that the Federal Reserve looks at to make its decision making, or personal income and spending. After yesterday's GDP print called into question the strength of the American consumer. Do they reprise that strength in a newfound sense of ongoing consumption?
Yields have been high. The dollar's been stronger. It's been problematic for pretty much everybody, including the Japanese. Japanese officials grappling with this one today. Dollar yen looking at 157. You heard me right. If you've been away for a few weeks and you're coming back into this market, we're not talking about 152 anymore. 3, 4 or 5. We're through 6 and we're looking at 157. Session highs, Bramo, 156.87 on dollar yen, and not a peep out of the BOJ this morning.
That was the biggest surprise. The fact that we're looking at these levels, which were thought of as unheard of way through the intervention points of yore, and suddenly you have the Bank of Japan basically not wholesale dismissing it, but saying that their job is not to support the yen wholesale, and it's not necessarily their main focus right now. What can they do then if it's not a Bank of Japan rate hike? A lot of people say they're waiting for maybe this core PCE number to come out softer than expected, or waiting for some kind of better intervention point. That said, I think that, again, we keep going back to this. Kit Juke's talking about 170 as a level, just because it's unclear what can break this trend if the Bank of Japan is going to remain on the sidelines.
The Federal Reserve decision next Wednesday. We'll have payrolls as well a week today. We've got PCE this morning. Plenty of opportunities just to reprice this market all over again. But let me tell you this, a company that doesn't need rate cuts, doesn't need a weaker dollar, it's Alphabet. Alphabet doesn't need any of that because apparently it's got a whole lot more. It's got a $70 billion buyback in the mix, an additional $70 billion yesterday. It's got a beat on the top and bottom line. Bramo, a ton of capex that no one cares about because it's going to be spending on the right things. We're up by 11.5% in the pre-market.
So we started the show with this, but I think it's worth repeating. Their market cap last night gained $250 billion. That is more than a McDonald's. They tacked a McDonald's onto Google. Then you add on top of that what we saw from Microsoft, which is essentially an implied $150 billion move. Walmart's market cap is $485 billion. They basically almost added a Walmart overnight to these two companies, just to give you a sense of the scope and scale. So when people start worrying about capital expenditure and share buybacks and dividends, it takes on a new meaning when you're talking about entire government of big tech prowess and promise, which is essentially what we're talking about here.
Should we go through the Mag 7 then so far this week? So
Please.
Tesla said the right thing, stock higher. Meta said the wrong thing, stock lower. Alphabet couldn't say anything wrong at all. That stock is absolutely ripping. We've got Microsoft positive too. Into next week, Amazon Tuesday, Apple Thursday, Nvidia later on in May. How are you thinking about those two names next week?
I'm actually more interested right at this very moment in Amazon, because are they losing cloud share? If they are, what does that mean for just how big of a share response you could see? With Apple, it's more interesting from a geopolitics standpoint, how much they're adjusting to the new intensification of the tensions between the U.S. and China. They also have a real question around some of the demand for smartphones, but it's a completely different story than cloud spend and this question of adoption of artificial intelligence on a broad scale.
And we understand, based on reports, that they are losing market share, particularly in one of their biggest markets in China. I've had plenty of reports on that over the last few weeks. Live from New York then, equity futures positive by 0.75% on the S&P 500. Let's turn to the broader markets together. Bond yields pulling back just a touch on a 10-year, backing away from 470, 467.95. And the euro, negative, dollar stronger today, 107.15, going into that data about 30 minutes away. Coming up is Troy Gayeski of FS Investments on why a recession isn't happening anytime soon. We'll speak to Michael Pond of Barclays, counting down to inflation data, and JP Morgan's Bruce Kasman on why Q1 surprises were a bump in the road. We begin with our top story. The Fed's preferred inflation read about 25 minutes away. Troy Gayeski of FS Investments saying this: it's hard to see what negative force would be powerful enough to crack the labour market to the point where the US economy rolls over into a recession. Troy joins us now for more. So Troy, if you are constructive on the economy, if you struggle to see reasons why the labour market breaks and the economy rolls over, how constructive are you on this market right now?
Well, from an equity market perspective, John?
Yes, sir.
Yeah. So for equities, I mean, look, the concern for equities up until really 21 and early 22 was not the earnings power. It was multiples, right? And so we had a big period of multiple compression in 22. We've re-expanded back to 20 to 21. So we're very confident that there'll be earnings growth. I think the question is, if you get the 10-year treasury yield up to 5 or 5.25, will you see another round of multiple compression? Not back to 15.75, but maybe somewhere between 18 to 19. So the risk for equities now is less about earnings and more about valuations. But to what you were just discussing, I mean, mega cap tech just continues to crush it on basically every angle. And so I'm very sympathetic to the argument now, given the market cap constituency, that multiples should be more permanently elevated around that 20 number. So we'd expect more volatility going forward, but nothing as problematic as we saw in 22. And we've already run through a mild correction so far.
We just spoke to Gershon Distenfeld of AllianceBernstein, and he said in the bond market right now, these prices, these yields, this is your second chance. You had a chance, a big one back in October. If you missed it, you get a second bite. Buy this now. Troy, is he right?
Well, I've never met a bond market participant that's not bullish on bonds, right? Regardless of yield. But obviously yields are much more attractive today than they were coming into the year, and certainly where they were at the end of 21. Our main point on fixed income, though, is because we continue to have stronger economic growth, which in turn is leading to a resurgence, particularly in super core inflation, where you strip out owner's equivalent rent, energy services. Those numbers look really, really bad for the Fed right now. You have to be realistic that if you leg in now, you could have 3, 4, 5 months of mark-to-market pain. And when you think about a normalized yield curve, a Fed that might not hike at all this year, where should the 10-year be if we can continue to avoid recession and inflation numbers coming hot? So risk reward is much, much better than it was coming into the year. But you still have to be cautious not to get over your skis. And we've seen a lot of that behavior, John, the last 2.5 years. Every time yields pop up, hey, let's buy fixed income rallies back. Then you have some bad inflation data driven by strong economic growth. You get a bear steepener. And it's almost been a rinse repeat. Whereas the flip side for equities has been, you have multiple compression because yields pop up, then earnings come out, and the earnings come out extremely strong, and then equities rally back.
So we were talking earlier about big tech being Mr. Perfect and the bond market being the parents warning about, needing to get life insurance. You just said something that are basically, we're fighting words. I've never met a bond participant that's not bullish on bonds. Does that mean that you are bearish on bonds? And just how bearish when you talk about where should the 10-year yield be?
Yes, fighting words is a strong term. I just watched, from the trenches the last 2.5 years, every time yields pop, time to get long duration. And that's led to some chagrin with clients. But, I think effectively, we're in the right range, that 4.5% to 5% range. But think about where inflation data continues to come out. with a softer economy than we saw last year. So it's entirely possible that we breach the recent highs of 5% and go slightly higher, which again, it's not the end of the world. It just means you have to be prepared for that. And then the flip side is if the Fed starts to cut, say, late this year or early next year, they're going to go at a very, very slow pace. And it's very easy to understand how the curve just twists, meaning the front end drops, but the back end doesn't drop at all. So you're going to earn at least your income, but you're not going to get the mark-to-market upside that a lot of bond market participants have expected and continue to expect.
So why not just be complacent? Own some of the big tech, own some T-bills, just rely on the fact that you're getting good income and sit there and be happy.
Yeah, I think you should never overreact, right? And I think right now the biggest challenge for investors is what to do with that massive cash pile they have. And in some cases, they're nibbling on duration. Didn't go so well late last year. On the other side, they're adding a little bit of equity risk. So far, so good this year, particularly, if you've timed your entry points well. And then, of course, the other side of that is to start adding to alternatives where you can increase return meaningfully, but not take uncomfortable levels of risk or uncomfortable levels of volatility. There's no reason to ever overreact in asset allocation, but incremental changes add up over time. And that's one of the key challenges today is how to deploy those massive cash forwards without taking uncomfortable levels of risk and still meaningfully increasing your return.
So we've been hearing this a lot over the past couple of years, Troy, the sort of allocation to alternatives. And we hear about private credit. We hear about other types of asset-based lending, asset-backed securities, a whole host of different strategies. At what point do we understand the valuations there? It's a less transparent market, and it seems like a lot of people have been plowing in.
Yeah, so I think there obviously has been substantial growth in private credit. A lot of that is just driven by the growth in private equity over the last 10, 20 years. When you think about the trend in markets, it's really, one of the reasons you have all this concentration in mega cap tech is more and more companies are deciding to stay private. So every dollar of private equity that's invested needs a dollar of private debt. In terms of market environment, look, as private lenders, we've been rooting for the Fed to hike as much as humanly possible and keep rates as high for as long as possible without cratering the U.S. economy. And here we are, right? And so when we look forward, the stronger economy means less of a hangover from a default cycle, which many people feared, including us, by the way, in 2022, and you're earning more and more income. So it's a great environment to be a private lender as long as you have dry powder to lend into this environment.
Troy complaining about bond guys talking their book, and then he talks his book straight afterwards. Troy, go away.
Hey, I can talk our book too, right?
I know you can. Troy Gajewski of FS Investments. Troy, thank you, sir. Appreciate it. Equities right now, positive by 0.7%. Lisa, the data, 18 minutes away.
And how big is the coiled response going to be? I mean, to me, the fact that we've seen such massive moves on not that significant data in terms of surprises one way or another just highlights how it's sort of hard to get ahead of this at a time when people are ready to go and change that narrative.
At the index level and on single names as well. I mean, you've seen that all week for the likes of Tesla, Meta, and Alphabet in various directions. Let's get you an update on stories elsewhere. We can do that with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Let's get you a quick check on Microsoft and Alphabet after big earnings beats yesterday, a 4% rise and 11.7 for Alphabet. By the way, if Alphabet manages to hold on to that near 12% gain, it will surpass NVIDIA's market cap today. Bank of America's Michael Hartnett flagged that record mega cap concentration in his note this morning, but said it will persist until real yields hit 2.5% to 3%, or when higher yields and spreads threaten a recession. Remy Cointreau reported recovering demand for pricey cognac in China, but that still wasn't enough to make up for a brutal downturn in the U.S. Jefferies' Edward Mundy said that there's low visibility on when a recovery might come. It's a similar pain that other premium alcohol makers are facing. Pernod Ricard CEO yesterday said there's increased momentum everywhere except for China and the U.S. Now, according to the Wall Street Journal, Donald Trump's allies have drawn up plans to give Trump a say in monetary policy. The plan would have the president consulted on interest rate decisions and give him the authority to remove Jay Powell before his term ends. Trump has long professed his preference for lower rates. The concern among some is that political interference would force aggressive cuts at a time of still elevated inflation, possibly raising long-term rates as the government rolls over trillions of dollars of debt annually. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. We'll catch up with Danny again in about 30 minutes' time. fascinated by this story. So this is according to people familiar with the matter. It is Wall Street Journal reporting. They have produced a roughly 10-page document outlining a policy vision for the central bank. I would love to hear from the former president, who's a bit tied up this week, I know, with other things. I'd love to hear him talk directly about what this is about.
How seriously they're going to take this. You've raised the specter of Turkey before, and potentially even of having to raise rates further to support the dollar if you start questioning the Fed independence. It's so hard to know what to take seriously and what to not. And this is something I know market participants are struggling with as well.
It's a question for Michael McKee in the news conference next week. I'm sure Chairman Powell's got lots to say on
Really?
the record
You think
about
so?
that.
Yeah,
No,
like what?
I think he's going to avoid that at all costs. Up next on the programme, inflation data on deck.
The market needs to see a couple of good prints on the data. You need to see probably 2 to 3 good inflation prints, whether PCE or CPI. And that probably, I would say, takes another 3 to 4 months minimum.
What would it take to reintroduce a conversation about rate cuts in America? How small would the data surprise need to be? That conversation's up next. This is Bloomberg. Very focused on the inflation data, I promise you, but also got one eye on the Red Bull design chief, Adrian Newey, reportedly set to leave Red Bull and potentially going to Ferrari, which for Ferrari fans would be absolutely massive.
If you were on set with Tom right now, we wouldn't even be covering core PCE.
No, we wouldn't. We'd be covering
yes,
that.
and we'd be talking about design.
How successful is Newey?
Yeah.
How dependent are Red Bull on him because he designs the car and
Right.
that's where the success comes from? And
Or is it?
could it change things for Ferrari and Lewis Hamilton when he joins next season?
Not that you'd rather talk about that.
No, I'd
Not at
much
all.
rather talk about inflation,
Clearly.
which is 13 minutes away. Equity futures right now going into that on the S&P 500. This is sport to me as well. This is like, I love
Just as
markets
good?
as much as I love Formula One and football.
This is like Red Bull design.
Absolutely. The design chief, I'm less interested in Formula One and football. These are the scores that matter to me.
Okay, literally, the more you talk, the worse it's getting.
These
Carry
are the
on.
scores that matter to me.
Move on.
We're down 2 basis points on a 10-year, 468.37. Under surveillance this morning, inflation data on deck.
The market needs to see a couple of good prints on the data. And we keep telling people it's a market of catalysts, not levels. So you need to see probably 2 to 3 good inflation prints, whether PCE or CPI. And that probably, I would say, takes another 3 to 4 months minimum and could be into next year.
It's the latest this morning. The Fed's preferred inflation read due in 15 minutes' time. The median estimate in Bloomberg survey calling for a 2.7% increase from a year ago. Michael Pond of Barclays saying this: regardless of how one slices and dices inflation, just isn't showing signs of further moderation. Despite the strength of inflation itself, the inflation market continues to price in a return to the Fed's target quite soon. Michael joins us now for more. Michael, let's start with the story, and then we can get into the price of the story. What are you expecting to see in about 12 minutes' time?
Well, usually when we go into core PCE, we already know what it's going to print because we know it from the CPI and the PPI earlier in this month. But this time around, yesterday's number threw a wrench in the story here because we got an upside surprise to the quarterly number. We're not exactly sure how that's going to play out versus the revisions in January and February. But if all of the surprise from yesterday came through in this morning's core PCE number, it would round up to 0.5. That is not only above the Fed's forecast, that is dramatically above. And, if we kept seeing prints like this, we would start to be talking about hikes.
Michael, where exactly did that upside surprise from yesterday come from?
Well, we'll have to see. We don't know the real details when it comes to the inflation print from yesterday. So that's why the monthly inflation print will be really interesting, whereas usually is just a confirmation of what we already know. So we'll be looking at the spread between the monthly prints, how much January and February get revised, or is it all in March? And then what are the details? Is it components that we can throw out and just say, yeah, more bumps in the road, or no, this is real. Inflation really isn't going down and the Fed needs to pay attention.
Michael, how much credence do you give this idea that it's just auto insurance and it's a one-time pop, that we see some sort of misvaluation of rents, especially given the fact that you have seen stability in certain markets, and that generally, from what you hear from earnings, there is a sensitivity to pricing by consumers?
Lisa, if you strip out everything in inflation that's not 2%, guess what? You get 2%. I think too many people over-massage the data to try to fit their view. The bottom line is that core goods inflation is near zero, but it's been near zero for a while. That's not going down further. Shelter inflation has stalled, so it's come down from its highs, but that's not going down. And super core, the core services ex shelter, also has stopped coming down. So regardless of which part of inflation you look at, you can slice and dice it to get the answer you're looking for. But if you're honest, inflation just has stopped going down. It's stalled at a level that's uncomfortable for the Fed when it comes to potential cuts.
Michael, you've studied inflation for decades, and this has been one of the key sort of debates about what's driving it and how sustainable it is, and whether rate hikes will actually help curtail it or whether actually rate cuts could help curtail it. Do you give any kind of credibility to this argument that higher rates are actually helping to fuel inflation by keeping the housing market stagnant and by giving certain people with savings extra cash to keep spending?
So not overall. There are certainly components of inflation that are sticky because of high rates. So you just mentioned housing. So the extent that potential home buyers can't buy a house because inventory is stuck, those who have low rate mortgages don't want to sell their house. They want to keep that low rate mortgage. And it's difficult to buy a house when mortgage rates are so high. That leaves more single family renters. So rent inflation remains strong because housing market activity is weak. That's pushing up on shelter inflation. But beyond shelter inflation, we still continue to see strength. That's a labor market story. To the extent that the Fed can impact the inflation, it's through the labor markets. Labor markets remain strong. At next Friday's employment report, we expect another 250K job growth and the unemployment rate to stay at 3.8%. That's not a labor market that's slowing. The Fed still needs to do more work on that front to get structural inflation down.
I was just looking at the estimates. Sneak peek of next week, 250 is the median estimate in our survey, which is unbelievable. We're still pushing out some of these numbers. Michael, I promised you a conversation about the price of the story as well. Given everything you've just told us, it begs the question, why is there so much faith still about a return to 2%?
You know, it just seems like, okay, this print is high, but next month for sure. And we're just not getting that. So, you know, the market seems to be going back to that definition of insanity, where over and over again they expect something different, and it's just not happening. The Fed has credibility, and you know it does seem like the market wants to buy into that Fed credibility. That as long as if inflation is high, well, the Fed's going to be hawkish, and therefore inflation will come down. We think that leaves break-evens quite cheap across the curve. But until the Fed shows that it might be more tolerant of inflation, longer-term break-evens are probably going to be stable in their current range. So it's really at the short end where we think there's potential for a big move up in break-evens. And at the front end, you have high real yields. Again, the market has taken out Fed cuts, or most Fed cuts, leaving real yields high at the same time that break-evens are low. So a hawkish Fed, but low inflation. Those aren't consistent in our view, and one of those should win out. We think that we need higher break-evens here to justify the high level of real yields and lack of Fed cuts.
Interesting. Michael, thank you, sir. You're one of the very best. We appreciate it. Michael Palm there of Barclays, setting up the conversation for about the next 5 minutes or so when we get that data. PCE just around the corner. Michael McKee joining us around the table to break some of this down. Mike, what are you looking for? And best guess yesterday, where did that surprise come from?
Well, the surprise probably came in upward revisions to January and February, as Michael was saying. But we'll look to that, and when you drill down into it, you got to go to 3 digits in these PCE monthly changes, and that's really nerdy economist stuff. But it will make a difference, because if that's the case, then we won't necessarily see March be pushed up as much.
How much of a surprise could some sort of beat in personal spending be, given yesterday's number?
It It's very possible, because what we know about spending is that the retail sales have been, for goods, have been weak. In GDP yesterday, goods sales went down. So it's services, and if services come in strong, as they did in the GDP numbers, then we could see spending be a little bit higher.
The estimate for PCE is 0.3% month on month. The data drops next. Going into it, the scores look like this in the equity market on the S&P 500, positive all morning off the back of decent earnings from the likes of Alphabet and Microsoft. We're up here by 0.7%. Mike McKee's going to break down the number, and then we'll get the view from JP Morgan's Bruce Kasman. All of that and more up next. It is the last big inflation read going into the Federal Reserve decision next Wednesday. That data drops in 20 seconds' time. The scores going into it look like this, beginning with equities positive by 0.7% on the S&P 500. On the Nasdaq, bouncing by 0.9%, encouraged by blowout earnings from Alphabet, from Microsoft. If you switch up the board and get to the bond market, yields going into this one have been elevated over the last month or so. The 2-year just south of 5%, the 10-year just south of 4.70. We are lower on the session by 2 basis points at 4.6712. With the economic data, here's Mike McKee. Morning, Mike.
Good morning. Well, it looks like sort of as predicted for the PCE inflation numbers. Both come in at 0.3%, the headline and the core on a month-over-month basis. We got to check that 3-digit number in just a second. On a year-over-year basis, the headline number is at 2.7. That's up from 2.5. The forecast was for 2.6, so a little bit more than expected. Same story for the deflator, the core deflator, 2.8% unchanged from the prior month. That is a little bit higher than anticipated, but not a huge move. It does show basically inflation is sticky and sticking around. Personal incomes up 0.5% as forecast. Personal spending, Lisa, you called this, 0.8%. The forecast was for 0.6. It was 0.8 the prior month. So Americans are still spending, gives more credence to the idea that the economy is strong, and with inflation where it is, this is certainly, I'm going to wager, this is certainly not going to change a lot of bond market thinking about when the Fed might cut rates.
Interested to see how the market responded to this. Straight away, spike in the equity market on the S&P 500. We're up by more than 1% now, up on the Nasdaq by 1.3. If you turn to the bond market, a rally started. Yields lower by 5 basis points on a 10-year, 4.65 on a US 10-year. Dollar yen still elevated for whatever that's worth, very close to 157 still at 156.85. Lisa, we've talked about this a few times, that sometimes with inflation, in line is like the new beat, or rather the downside surprise. When it comes to inflation, people are so spooked by the data yesterday that maybe the 0.3 is almost a relief.
Well said. I mean, I would just build on that by saying that if there had been an upside surprise, that was almost what this market was girding for. I wonder how long it's going to last, though. If this is a market that is fully internalized, what no rate hikes this year looks like. Because if what we are looking at right now, I love what Michael Pond said. You could strip out everything that isn't inflationary and you get 2%. But right now, you have to wonder at what point you're looking at the new reality. And I think more people are going to have to grapple with that in the weeks to come.
PCE this morning coming in at 0.3%. The estimate in our survey, 0.3%. Month over month. If you are just joining us, equities are a lot higher in the equity market right now on the S&P 500, up by something like 1 full percentage point, encouraged by what we've heard elsewhere from Meta. Earlier this week, they were down, but the likes of Alphabet and Microsoft doing better than good in the pre-market this morning. If you turn to the bond market, yields are lower by 4 or 5 basis points at the moment on a 10-year, 4.66. On a 2-year, at about 4.97. We're down 3 basis points at the front end of the curve. Mike, you've had some more time to go through this. What jumps out for you?
Well, I did look at the 3-digit moves, and it looks like at this point that January and February were revised higher. So you've got 3.8 for January and 3.4 for February. So that's where most of the change comes in. The March numbers come in at 3.00 or 0.300 exactly, so right on the number, and doesn't suggest that there was a big inflation build in March, which is good news. When we look at the personal income numbers, the important number is always wages. Compensation is up 0.6, wages up 0.7 for the second month in a row. So this tells you Americans still have money coming in and they can still spend. And we know from experience that basically people spend what they make. That's what drives them in this. So at this point, the numbers are pretty good. And as we said, spending was higher than anticipated.
Well, I understand the stock market pop because of that basically this takes the stag out of the equation. This basically goes back to just the immaculate disinflation, except without the disinflation, just the immaculate, which raises this question about why this bond market is rallying on the heels of, on the margins, a hotter than expected print, but pretty much in line. Is there a sense that this is basically front loaded this year and that you still could have that disinflationary impulse? Or is this just basically the hope and the dream the Fed's going to find a reason to justify rate cuts regardless?
I don't know if they find a reason to justify rate cuts regardless, because their goal is to bring down inflation, and they've lashed themselves to that mast so tightly that it would be hard to see them just try to push it through. But do we see inflation start to come down again? It's really hard to say, because a lot of what's been happening are one-off things you mentioned earlier that we don't know if they're going to continue. I haven't looked at the complete breakdown of the PCE numbers, but we know real estate's been an issue. And we know there have been things like cars and airfares and things like that have been issues. Do those continue to put upward pressure on? And what's the service industry pressure coming from? Are we seeing inflation because companies are raising pay because they're trying to attract workers? So those are the questions that the Fed has to answer, and we don't have good answers for all of them yet. As far as the stock market, not to tease ahead to Bruce Kasman, but I'm with him. We were talking off air. I don't know anything about why the stock market goes up and down in these.
Yeah, we're not going to ask Bruce about that. I can tell you this, Mike. I often say this whenever we get economic data at about 8:30 Eastern time. First move is not always the right move, and we will see if this sticks. But this is the move we have in front of us right now. There's a rally in bonds. Yields are pulling back. I think it's just a feeling, Lisa, and I think you'd probably go with this. This isn't about rate cuts. This is about whether this keeps rate hikes at bay. And data like that is going to keep that conversation at bay going into next week and beyond.
Fair. That's the whole thing about what you said earlier, this idea that anything in line is a beat, because essentially it doesn't necessarily reintroduce any risk. At what point, though, do all of these hotter than expected prints, one after another, it was supposed to be 3 that made a trend. Well, we've gotten that. At what point does that raise the question of, are we really understanding this paradigm correctly?
If you are just joining us, 0.3 was the estimate, 0.3 was the result on PCE. Equities off the back of it, positive. We've faded some of that move. If you look at an intraday chart of the S&P 500, spike higher, fall back, positive by about 0.9%. You got more detail, Mike?
Well, here's something that you may not have expected. If you're looking at overnight index swaps as a forecast for what the Fed might do, they have now priced November back in. Why? You got smarter people coming on. You can ask there. Fed funds futures still don't, but the swaps are pricing November. And that's very volatile, but it's interesting.
We were eating away at December yesterday after that data. We've been all over the place this week. Let's get to Bruce Kasman of JP Morgan. Bruce, Lisa's been quoting you all morning. That quote is the sound that you hear as a narrative cracking. How does this data inform that view?
Well, I think it's pretty supportive of that view on a number of fronts. Obviously, the one that people have been most focused on today is the inflation news. And certainly we got a more distributed, outcome of that surprise. It wasn't all in the March number, but the March number at 0.317 on an unrounded core is still pretty darn firm. I haven't seen all of the details as how that's distributed. I don't think the super core services were that high, at least what I see. But the basic point here is this is no longer something you can explain as just the beginning of the year pop. But I also emphasize 2 other things. One is, as you look at the data on income and spending here, we're getting very strong wage numbers. And I think there's probably some pressure here on wage inflation as well as there is the strong income numbers. We'll see the employment cost index report for the first quarter next week. And then the other thing here is we did have a squeeze on incomes to some degree, both for taxes and higher energy prices in Q1. And consumers held up pretty darn well. And one of the reasons is the savings rate went down. The savings rate is 3.2% in March. And I think that's a message that wealth effects are moving here. So there's both a story here about the economy holding up very well with high interest rates, as well as inflation pressures being persistent. And while I don't think it's right to talk about this from the point of view of Fed tightening, I think the case for Fed easing here is pretty small anytime soon. We'll see where we are 6 months from now, but certainly the Fed's going to have to change its tune about its its view that there's a fair amount of easing that's coming down the road.
I would just add that real personal spending actually increased to 0.5% from 0.4%, even though it was expected to fall. Bruce, given the fact that we're seeing or hearing that sound of the narrative cracking, what's the new narrative? Is it just no rate cuts in your case?
Well, I think the clear part of the new narrative is high for long on rates. The question is, where does that take us? And we've been actually struggling with that. We have kind of two scenarios we think are both reasonable. One, we've been calling boil the frog, which is high interest rates do weigh on performance. They do start to create vulnerability on balance sheets, particularly the business sector side. And that causes problems for us, not now, but maybe 6 or 12 months from now. The second one is we find out that we actually can live with higher interest rates, that we've had better supply side performance. The economy is in an underlying resilient position, and that actually this is a new world, and we should understand that the economy has higher interest rates and is sustainable. Between those two right now, I think there's really support for both and some of the things we're seeing, and we're not trying to take a strong call on what the new narrative is going to be.
You do, though, think that there is going to be a new tone from the Federal Reserve next Wednesday when they give their press conference. What do you think is the right way to weigh the risks right now? How much should they shift away from what we saw in December?
Well, I think you have to remember that the May meeting is not a forecast round meeting. The May meeting is not one where we got a lot of new information since the last one. We really get a lot more with 2 payroll reports, 2 CPI reports up to the June meeting. So I think this is a bit of a way station. I think what Powell is going to do is he's going to basically say he's lost a lot of confidence in the views in terms of where inflation is going, but they haven't really shifted those views in a material way. He's going to downplay what the SCP in March was telling us, which still had 3 cuts for the year. And he's going to look to June for the bigger shift in the Fed. And obviously, we'll see that in the light of what we get in the next 2 sets of readings on both CPI and payrolls.
Just got a note, some reaction. This from Inflation Insight. The title of the note is just Core PCE, Few. I think a lot of people feel that way. Based on the information we got yesterday, there was a risk of a big upside surprise this morning, which is why we're basically saying that inline feels like a downside surprise relative to where expectations went to. That shift higher in yields. Yesterday, new highs for 2024. This morning, pulling back, particularly on a 10-year by 4 basis points, about 466 this morning. Bruce, I'm thinking who else is saying few this morning? It's officials in the Ministry of Finance over in Japan. If they're looking at dollar yen, staying up at 156.87 and approaching 157, the last thing they needed was an upside surprise. Bruce, can we take this global? What are global central banks, finance ministries around the world staring down the barrel of this resilient, strong dollar? What are they going to do?
Well, first point to make here, which I think is really important, is we're seeing a world in which growth is broadening its base. And I think it is starting to take some of the weak links, including Japan and Western Europe, into a better position. I think in terms of what central banks are doing, there is more differentiation. We think the European inflation picture is looking a lot better than the U.S. So I think there is some room for easing. As you noted, Minister of Finance is probably breathing a sigh of release. I'm not sure they're that happy with the way the BOJ talked to us overnight. They were considerably more dovish than we expected in terms of their guidance. But I think the basic message here is you're going to get some easing in Western Europe. I think the BOJ is going to be patient here, but as you say, the yen is going to continue to be under downward pressure relative to the dollar. I think the pressure will build. I think ultimately Japan is going to do more and the economy is going to do better than people expect. And I'd say that more broadly about the global economy, that they'll do less on easing, the BOJ is tightening, and we'll get better global growth than people anticipate at this point.
I know this is a difficult question and everyone has a slightly different answer, and some people say it's not relevant at all. But where are we in the cycle, in the economic cycle, if you're talking about a broadening out and a firming of Europe, of Japan, at a time when a lot of other people are talking about U.S. exceptionalism and the potential for late cycle types of behavior?
So I think we come back to this tension on high for long. And I think what's embedded in the high for long is an inflation dynamic, even once we've taken out the highs that we had in 21 and 22, and a position in terms of monetary policy, labor markets that screams late cycle. But I think what the pandemic has done is it's both created that dynamic as well as a far more positive dynamic in terms of where the positioning, in terms of leverage, durable spending, profit margins, things like that are normally late cycle signals that tight monetary policy is going to do damage. So I think we're in a kind of a weird new world of late cycle inflation in central banks and early mid-cycle private sector behavior. How that plays out, I'm not feeling very confident right now. As I said, I think there's this possibility of the boil the frog and we gradually grind to a problem. But there is a possibility we can sustain this for a while longer, a while being a few years.
Interesting. Bruce, thank you, sir. Bruce Kasman there of JP Morgan. A while being a few years just makes you think of a theme that, Lisa, we've been talking about in this programme, the prospect of it being post-GFC in reverse, where you're sort of sitting there waiting for liftoff, and liftoff never comes. You have to wait like 5 years for it. I wonder how long we've got to wait for that first cut.
It's already been that way for a number of months, where we just keep talking about, well, next month. Was that also Michael Pond saying next month it'll be softer? And every month it seems to be the same story. The idea of a weird news cycle, how we invest around that, is definitely causing a lack of conviction, which is the reason why you see such significant moves, even on no real new information.
Well, I can tell you, stocks are back to where they were going into the print, basically, on the S&P 500, positive by 0.8%. Mike drops by because he's amused by price action sometimes following data points. Mike, you've got to find a word on this.
Well, I think Omar Sharif had the best word, phew. That seems to be what the market's reaction is, that we avoided a real problem, but it doesn't change the narrative at all. We're going to be still waiting for the Fed to cut. My two thoughts on that were, one, that Godot never showed up, and two, that the economy lived with rates like this for decades, and now we may be back to, we got to get Muhammad out, back to the old normal.
The old normal, not the new normal.
And people will adapt.
Mike, love it. Thank you, sir. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Blackstone is getting ready for a less risky, even more boring era for their private credit division. The head of the unit told me that to grow to $1 trillion, they're hunting for more deals in investment grade and asset-backed finance.
The asset-based finance market, which is a much larger addressable market, $25 trillion or higher, is a very large opportunity for us. And given our scale and our size, with about $420 billion on our platform in credit and lending at Blackstone today, it gives us this really unique position to take advantage of what's happening.
Gilles Dillard spoke with me exclusively in his first interview since taking the role. And the University of Southern California has canceled its main commencement ceremony as pro-Palestinian demonstrations continue. The school cited safety concerns. Administrators had barred the valedictorian speech over her social media posts about the Israel-Hamas war. Dozens of smaller ceremonies will be held between May 8th and 11th for the university's individual schools. So far, 90 protesters have been arrested on campus. USC says that many of them were not affiliated with the school. Let's get you a quick check on Intel shares. They are lower by 8.5% in the pre-market trade. They're already down 30% this year. Intel gave a lackluster forecast in their earnings as it's still struggling to get back to the top tier of the industry. Stifel's Ruben Roy wrote that while 2024 should mark a bottom for Intel, the pace of the climb back up is still unclear. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. Have a wonderful weekend. Equity futures right now on the S&P positive by 0.8%. Up next on the programme, breaking down the inflation data coming in at 0.3% just moments ago. We'll catch up with Morgan Stanley's Andrew Sheets next. S&P 500 futures basically back to where they were at 8.29, which was a minute before the inflation data came out. We're up by 0.7% here on the S&P 500. Yields are a little bit lower. We've faded some of that initial move. We're down about 3 basis points, 467.75 on a 10-year. Under surveillance this morning, no bad surprises.
One that people have been most focused on today is the inflation news, and certainly we got a more distributed, outcome of that surprise. It wasn't all in the March number, but the March number at 0.317 on an unrounded core is still pretty darn firm. The basic point here is this is no longer something you can explain as just the beginning of the year pop.
It's the latest this morning. Stocks rising, yields falling after the core PCE deflator came in at 0.3% in March, in line with expectations and reinforcing the view that sticky inflation will leave the Fed in no rush to cut interest rates. Morgan Stanley's Andrew Sheets joins us now for more. Andrew, can we just get your initial reaction to that data from 20 minutes ago?
Yeah, thanks. I would echo kind of earlier comments. It wasn't as bad as expected. It could have been worse. I think after yesterday's numbers, there was a risk that you would have gotten a much higher number today on core PCE. I think that would have been much more damaging to the market narrative, narratives like our own, where we're expecting the Fed to be cutting several times in the back half of the year. But I think at the moment, it wasn't as bad as expected. The jury is still out on that, and the market will continue to be very kind of reactive and wait for incoming data.
Soft landings, as you've said repeatedly, they're super rare. Do you think the data's still tracking one?
We still think it is. I do think the growth data from yesterday was a little bit better than the headline number might suggest, given, once you adjust for inventories and exports. The inflation is not coming down as fast as we expected, but I think it's important to note that the Fed, still thinks that core PCE will be at 2.6 by the end of the year. And in that scenario, it's still cutting 3 times. So, I think that the moderation in rates, in our view, and we think in the Fed's view, doesn't require inflation being at target by the end of the year by any means, as long as we can see some progress. And I don't think we've seen that progress yet, but there's still some time. We still think we could be cutting rates modestly this year, and I think that's still very consistent with a soft landing type of scenario.
Andrew, we were just speaking with Bruce Kasman. I'm sure you heard it, and he was talking about him toggling between these two potential narratives. The idea of boiling the frog, where high rates eventually bite and create something that's more pernicious than a soft landing, or the idea of the new normal, which is basically we can live with rates here. Why do you think that we actually are going to be in the new sort of different kind of paradigm where we're going back to the old, which is neither of those two?
Yeah, so I do think it's interesting that when we think about, going back to the old, and you mentioned before the break, kind of this idea of the old normal, and is that a problem for assets? Is that a problem for credit? And, I think it's important to remember that the modern era tights for credit spreads, weren't during QE. They weren't during the structured credit boom of 2004 to 2007. They were in the mid-90s. They were in an environment where rates were high, where rates were higher for longer, where growth was okay, where the Fed cut a little but didn't cut a lot, and where corporates were slow or took time to really ramp up their aggression. So I think we can look at environments where higher rates in and of themselves are not necessarily a bad thing for credit. I think that obviously means you need to change your strategy somewhat. You need to think about kind of what could be larger and weaker beneficiaries of that. But, I do think the mid-90s continue to be a very interesting template for what's going on and a quite actually optimistic scenario of how the market can deal with a somewhat higher interest rate environment.
We were speaking with Gershon Distenfeld earlier this morning, and he was saying if you missed the opportunity to buy earlier, this is a good time to get back in. Would you agree with that, with the idea that higher yields, particularly on higher quality bonds, but also lower quality ones, look pretty attractive?
So I think our advice here it differs a little bit by what part of the fixed income spectrum we're talking about. So our rate strategists are neutral, and I think that's a function of, over a 12-month period, we're expecting yields to decline. We're forecasting pretty good returns for government bonds, but the carry on government bonds is negative. The seasonality in April is historically pretty poor. The data's been good, and supply is heavy. So those are some, notable tactical factors that are still kind of working against you and kind of keep us on the sidelines. Similarly with mortgages, you've had a lot of rate volatility, which is, just very unhelpful for mortgage type of risk taking. But on the credit side, we're a little bit more optimistic. I do think this is a somewhat more friendly credit environment. Credit is an asset class where net issuance is lower than government bonds. The carry is much better. The improving PMIs that we're seeing is more helpful historically. So, I do think credit's a place that we think can outperform a little bit on a relative basis. And then within credit, we really like loans. It's a floating rate asset. Spreads there are average, not expensive, and the all-in yields are high. We think it's pretty well suited if we're in a somewhat hotter, somewhat higher for longer environment.
You alluded to supply. Can we finish on that? There's been a huge amount of supply to kick off 2024. I think we'd all like to know a couple of things. Has the window been open for lower rated credits? And a question we've asked on this programme quite a few times now is how many bricks have we taken out of the so-called maturity wall that goes into sort of late 24 into 25?
Yeah, so we think that maturity wall is looking pretty good. A lot of bricks are coming out, so to speak. And look, there's still wood to chop there, but when our analysts in the U.S. and Europe look at that data and we break it down in quite some detail, we're making our way through that maturity wall at about the average pace that you usually do. And so I think you continue to see a market in credit that has a lot of differentiation. We're seeing a lot of idiosyncratic risk. We're seeing a lot of dispersion. The yield spread between, say, triple C's and single B's is very wide, despite the, seemingly very strong market. So this is a market that's still differentiating. It's not funding anything and everything. But I think on the whole, we're seeing that maturity wall be worked through pretty well. And that's a reason why we think the peak of the default rate for high yielder loans is going to happen in the first half of this year. It's going to be somewhat lower in the second as that gets a little bit better.
Andrew, this was great. Fantastic to get your reaction to the data. Andrew Sheets there of Morgan Stanley, responding to inflation coming in at 0.3%, in line with the official estimate in our survey, but maybe a little bit below where people were based on the information we got yesterday. Next week on Monday, have a wonderful weekend. On Monday, we'll catch up with RBC's Laurie Calvasina, Jay Bryson of Wells Fargo, Sarah Hunt of Alpine Saxon Wood, Stephanie Roth of Wolfe Research, looking ahead to payrolls Friday and a Fed decision on Wednesday. From New York, this was Bloomberg Surveillance.